commodities. China is just buying up, and their support, Xi Jinping in that sense is supporting Tehran and Moscow.
The Iranian foreign minister is here in the United States. He's making waves. He's warning the United States, you will not be spared if the Israel-Hamas war spreads. These are aggressive tone and aggressive statements. How serious should these statements be taken?
Well, a lot of it right now is fiery rhetoric. And of course, Hossein Amir-Abdollahian has to come out and he has to say this. There's been a lot of backlash, though, on the Biden administration for even giving him a visa, for even allowing him to enter this country. Now, during UNGA week, you do see foes of the United States enter, but this is not UNGA week, and we've seen in the past the Trump administration didn't allow a visa for Jawad Zarif. We've seen in the past even the Obama administration not allow some visas. So there's even been a lot of criticism towards the Biden administration, the State Department, for why Amir Abdollahian got this visa. But this is fiery rhetoric, and it comes on the heels where overnight there were U.S. strikes on facilities in eastern Syria, where the United States says the IRGC is actually there and operating. The issue we don't know with these strikes is what comes of these strikes. Is it military personnel that the U.S. was targeting? Is it military capabilities? Until we know that, we will understand how much of a deterrence this was.
Looking more domestically and what's happening in the House right now, how is this going to impact these geopolitical conflicts? I think obviously the funding, very soon we are going to be upon a new wave of concern about the shutdown and what that means. And the funding for these foreign conflicts is a huge part of that.
So two big issues in the House right now. There's a brand new speaker. He has a little bit of a learning curve, to put it nicely. He has not been part of leadership. And he was at the White House yesterday. So Shalonda Young was there, director of the OMB, obviously talking about the potential government shutdown November 17th. This individual, Mike Johnson, has said he's up for a CR, but with conservative values with it. So potentially some cuts on top of a continuing resolution to keep the government open. Put that aside, there's also these national security concerns. Jake Sullivan was also in that meeting. So he was a sobering reality, I think this individual probably got at the White House in terms of the conflicts that are happening around the world. But he went on Sean Hannity last night, and he said he wants to separate the funding request from the White House when it comes to Israel, when it comes to Ukraine. And he said, what is our end game in Ukraine? So he wants $14 billion for Israel, but where does that leave what is going on with Putin's invasion of Ukraine? That is going to be a little bit harder for this Republican-led House to vote for. The issue is the Republicans have a very slim majority, and that majority might get even slimmer. George Santos is appearing in federal court today on Long Island, and there's an expulsion potentially from him next week by his Republican colleagues, the moderates, who say we need to throw him out. They lose that seat, their majority becomes so much razor thin.
Which is the reason why earlier this morning when we were talking to Isaac Boltanski, he said, basically, this is not a speaker that has any chance of bringing together these different fissures. Yeah, exactly. It's a weak speaker. So there's a question of what actually gets done. Does this make it less likely that we get a shutdown or more? Anne-Marie Hordern, thank you so much. We really appreciate seeing you in New York and not for UNGA week. Whenever you say that, I'm sorry, I laugh because it's UN General Assembly, and I think about that, and UNGA sounds like that song that we were singing every time you come on and talk about this. We are about 5 and a half minutes away from this key economic data. Laura, how important is it?
I think it's on the spending side already baked into Q3 GDP data, which we knew was strong. The inflation data is going to be more important. The last CPI reading was less friendly than the market expected. It was not terribly well behaved, and the Fed has made such a spotlight on this little sliver of services inflation. I feel like that might come back to bite them as it kind of has risen again recently.
I like how she makes inflation seem like an unruly child, not quite as well behaved, not as tamed. Basically, the concern about reaccelerating inflation, really key in people's minds right now, Menace.
She's experienced a commercial break where Anne-Marie comes in and somebody else goes out, unruly children on surveillance, but it is about not as unruly as the brief. In terms of the trajectory, lots of people have said, look, the inflation is disinflation is perhaps going to surprise us all. You started the show by that. Will it, briefly?
I am actually the one person, my off-consensus call is that I think inflation is going to be stubbornly high.
Which is, I think, something people are grappling with, which might be part of the reason why yields are where they are. Coming up on the open, we're going to get there in just a minute. Marky Patel of Allspring, Tony Rodriguez of Nuveen, Jay Pulaski of TPW, and Rob Sanderson of Loop Capital.
the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it.
Yeah.
Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's Bloomberg Surveillance. Lisa Abramovich has absconded. We're waiting for the PCE data. We're joined by Mike McKee around the desk. So we're waiting for the personal spending, the deflator. Mike, will it be disinflationary? Roll of the dice? That's the question. We're waiting for the numbers to come down on the Bloomberg terminal.
Well, got about 4 seconds until that happens. But the idea is we may get a little more disinflation. Let's find out from the Bureau of Economic Analysis. And here come the numbers. And we'll start with the inflation numbers. They come in hotter than anticipated, up 0.4% on a month-over-month basis for the headline. The core comes in up 0.3, which is about what was expected, although there was some leaning towards maybe a little lower number. Year over year now, we see the PCE headline number at 3.4%. That's down from 3.5, and the core comes in at 3.7, down from 3.9. Both of those expected. All the people who like to dive into all those numbers and figure out what actually changed will be with us in a few seconds. Personal income up 0.3. That's lower than the prior month of 0.4 gain, but also lower than what was anticipated, 0.4 gain. Spending up 0.7.
I mean, that's strong on the back of that on the back of that GDP and the consumer.
Well, this number is in the GDP because this is the September number. It was the third month of the quarter, so economists had sort of backed out the numbers and anticipated that this would be fairly strong. We were up 0.4 the prior month. The question is now, do we continue to see that spending happen? Because if incomes are falling behind, and they have been, the spending levels over the last couple of months, that would suggest that maybe there's a pullback ahead. Now, I'm not the expert here. There's one more.
There is indeed. Laura Rain, chief economist, with us this morning. First take?
I think that we continue to see inflation coming down, but it's still unacceptably high from the point of view of the Fed. And I think the conversation as we go into next year continues to, the options for the Fed continue to narrow. Because if inflation stays about where it is, and it's going to take a long time for it to get closer to 2, their room to maneuver, should the economy slow at all, is going to be very narrow. And look, by these numbers, it looks like the economy is just still incredibly strong. We know that from the GDP numbers that we already got. But, I mean, the spending has just, by the households, has defied every expectation of it to slow. And it's accelerated so much in the third quarter. That's what's extraordinary.
I think
Savings rate comes in at 3.4%. People have been watching that for some indication of whether or not they're going to run out of money, the American consumer. That's down from 4%, and it's been a steady decline. But historically, before the pandemic, we used to say people spend what they make. They don't dip into savings the way people tend to think they do. And so if that's the case, then there's more of a case now for maybe a slowdown. People don't have as much to dip into if they wanted to, but they're also not making as much as they were.
Well, I had Janet Henry with me this morning from HSBC, and she said actually Americans are more likely to dip into their savings and spend right till the very end. But I want to bring you an idea from UBS, which is Paul Donovan, where he said, you know, when we go to write the history of the 2020s, do not bet against the hedonism of the U.S. consumer. It's very rich. I love it. I mean, there's a brilliant wine place in London called Hedonism Wines. Whole other story. The hedonism.
You can tell us that later.
I can tell you that later. But I want to understand from you, Lara, the hedonism of the U.S. consumer, is that real? Or do you think that runs out of mileage as well next year?
Listen, he's got a point. That's a really colorful way to put it. But that's what the third quarter felt like, between the headlines about the concerts,
Taylor Swift,
all of the and everyone who followed. I think people seem to be looking for that next experience and looking to pay whatever is required to get it. This issue of savings is gotten so complicated because we, of course, have the excess savings that accumulated during the shutdown.
Yes.
Is that more, bucketed with these, sort of now the highest quartile of households that sort of maybe aren't going to spend them as much? We know that excess savings is run out for a lot of the lower, sort of strata, the other 75% of us who are not in that upper quintile. I think as we think about
you mean the normal people?
The normal people. I think, and yet, we just see, and the strong job growth, I think, reinforces the foundation of the household. And we just see this reacceleration is really unexpected.
In terms of your hedonism example here, services spending went up 0.8, whereas goods spending went up 0.7. There was always a story about people switching away from goods, but they still seem to be spending a lot on goods. Services don't go into the retail sales numbers that we got earlier this month, except for bars and drinking places, fitting your theme.
More hedonism.
But 0.8% gain for services, pretty strong. So it looks like people were spending money during the third quarter on all sorts of things.
I do think there's an interesting dynamic here, which is that if you look at consumer confidence, it's still well below where it was before the pandemic. And that's, despite strong growth,
So can you tie those two together? The consumer confidence being a little bit battered, but the spending, it remains unabated.
To me, I think inflation is something that is still really casting a long shadow over the household. Because, when I'm not here, I'm the mom at the grocery store, and I've got one bag of groceries, and it still costs me $95, and I can't figure out what's in it, So I think, this idea that year-over-year inflation is coming down, but the sticker shock is still a very real and present pain point to household budgets.
And Coca-Cola are raising prices, and Netflix are raising prices, and there are
Apple TV,
and Apple TV, they're raising prices as well. And we are moderately immune to those. Do you know that? You'll still order a Coca-Cola. You'll still order your Netflix movie, Mike.
Well, I was looking here to see if we get Supercore. I haven't got that number pulled out yet, but that's the one that the chairman of the Fed says he likes the most. See if we have that number calculated yet, because you got to take out houses.
And it's the CPI number that had risen the most since about a year. So I think that's going to be a key piece of today's report too.
Well, just looking at the bond market, it's virtually flat. I mean, 485 is where we are on 10-year government bonds. So there's a sort of a flat, sort of unknown entity within the bond market. Let's just check in on equities, up 0.4%. Again, you've got an Amazon recovery, a nice kicker there. It was up 6% at one juncture, giving a little bit back. You're looking at 10-year yields, just still incrementally rising this morning at 485. We just had BMO in Lingen here with us saying, look, the next 3 weeks will define where the end point is for the bond spike in yields. Oil is up 1.93% this morning. Again, there's more geopolitical angst with military action in Syria from the US side, and that has brought, again, a geopolitical bid back to the oil markets. But personal income rises 0.3%. The estimate was for plus 0.4%. So, Mike, the takeaway from this is the core price index rises to 3.7%. pretty much in line with the estimates.
We're seeing disinflation. I mean, the rate of inflation is slowing down. It's not slowing down as perhaps fast as people would like. And to Lara's point, especially about being the mom at the grocery store, prices go up at a slower rate, but they don't come down. So you're paying more for a lot of staples, and they're going to just stay at that price. And so people look at that, and they're still experiencing inflation, even if inflation is not as bad as it was before.
What happens then to this view in the market that we're going to get rate cuts into 2024? Does that debate change?
It's got to continue. The Fed, I think, now has to just continue to wring rate cut expectations out of that futures curve. I feel like this is the deal with the devil right now, because if you had told me that we were going to have GDP growth of almost 5% and the Fed was not going to cut rates again, I would have just not believed that that was a possible outcome. But Fed futures markets are not pricing in another rate cut. Markets seem very convinced the Fed is done. And I think the only way that works is if we continue to get this drift higher in long-term yields, and there's room for that. Because today, markets have 75 basis points of rate cuts priced in for next year. So if the Fed is going to kind of stay on hold, there's room for that to continue to come out and for long-term rates to continue to move higher.
How do you think they'll look at this in the Fed, Mike? If you look at this, the top line is PCE is at a 4-month high. Consumer spending picks up. It doesn't leave them that huge optionality to be very, very dovish, does it?
They can just sit on this at the moment, because they forecast in September, the last time they did forecast, that we would see PCE core at 3.7% at the end of the year. Well,
we're there.
It's bang on where we are. So most economists think with a couple of months to go, we're going to come in below that. So the Fed could argue its targets are being hit. And you mentioned Ian Lingen. He had a great note this morning about how we're starting to see more impacts from higher Fed rates. And that is slowly getting into the economy, and we should see more. So the Fed is probably going to sit there and say, what we're doing is working. We're at a level where inflation is still coming down. We don't have to go up more right now with all this uncertainty out there about what's going to happen.
Well, and unless inflation is at 9%, there really is no emergency reason to raise rates. That's usually, not a thing. So they, to your point, they have the time. And yet, to me, this increase in long-term interest rates is the reason that they can be patient. And that is going to continue to sort of pump the brakes on activity. When I look ahead at next year, my forecast is for slower growth. I think these higher interest rates have actually increased the chance of a recession, not decreased it.
Is that slower growth no landing, soft landing, not hard landing?
I think it has to be a soft landing. I still feel like there is very real risk of recession next year, and we cannot discount that. But all the reasons why we've been saying it might be a mild recession could also mean that you just end up with some sluggish growth.
So, Mike, as we go towards the close of the year, what's the next piece that you're going to hang your hat on in terms of data? We've got Michigan, University of Michigan this afternoon.
Yeah, I don't think that's going to move the needle a whole lot, but I think what we are going to focus on is all the data next week, particularly the ISM numbers and then jobs at the end of the week. The Fed meets on Wednesday, so they won't have the jobs figures. But at this point, to get an idea of where they're going to go in December, there's less than a 2% chance they do anything on Wednesday, but nobody expects that. But the question is then what happens December, January, and the jobs report will contribute to that. That's what we'll be
checking in. Okay. For our listeners, for our viewers out there, if you're just joining the program, here's a quick check on the markets for you. We have been a little bit higher on these equities this morning. S&P is up 0.25%. S&P avoiding the brutality of a correction that you've had in the NASDAQ. Euro declines by 0.25%. Do you want to be longer of dollar in a haven position? Christine Lagarde managed to do a press conference without any injurious backlash in Europe. Yields tip a little bit higher this morning at 486 as the PCE hits the highest level in 4 months. But the core personal consumption expenditure, stripping out food and energy, the volatile components, rises at 0.3%. And we'll keep an eye on that. Crude is up 189 as we see a little bit of additional geopolitical risk overnight with targets being hit in some of the proxies. So keep an eye on the oil market, still down for the week, just over 2.5%. We'll give the closing thought to Lara Rain. She's the chief economist with me this morning. At the end of an hour of analysis, a flat, damp squid on the data, really. Your closing thought?
You know, I think this is a week where we're winding down. I think there's been so much news. Today is a day of digestion. As Mike said, we've got a lot coming down the pike next week. Earnings continue. We've got the employment numbers. We've got the ISM numbers. And the Fed meeting, you know, while nothing is expected, I think the press conference always makes us all sort of watch the TV with anticipation and see what was going to happen. I think, you know, at the end of the day, the reason why the Fed has not pushed back on these higher interest rates is because they're probably pretty happy with that move.
Okay, Lara, you stay with me. Mike, thank you very much. That's the first physical outing that we've had with Mike McKee since I've been in America. That was a big moment for me. Mike McKee on the data.
Welcome.
Thank you. Thank you very much. Coming up, we're going to catch up with Marcus Ashworth right here on Bloomberg Surveillance. Good morning from New York.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg. Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power. We're going to make more money. We're going to make more money. And we're going to make more money.
You're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
We're seeing yields go up in most advanced countries. Part of the increase in yields, I think, is simply a reflection of the strength of the economy, the notion that interest rates will be higher for longer. I think it's perfectly possible that we will see longer-term yields come down, but nobody really knows for sure.
Janet Yellen, the U.S. Treasury Secretary, speaking to Bloomberg's Peggy Collins on why these bonds have gone parabolic this week. With me around the desk this morning, we have Marcus Ashworth in the United Kingdom, and we have Lara Rain here, the chief economist. I want to start the conversation with you, Lara, which is listening to Treasury Secretary Do you agree that it's not because of deficits, because the U.S. is so strong? That's why you've had a bear steepening that would knock your eyes out.
You know, I think, of course, it is partly the deficits. These Treasury auction sizes are enormous. They're not going off quite as smoothly as they were when the Fed was engaged in quantitative easing. Now they're tightening. I think that's a piece of it. And then, of course, you know, we just continue to see the data just ripping in a very strong pace. So it's all together. It's hard to you know, really break it apart and tell what's driving what, but the deficits are absolutely a component.
Do you think the attack of the steepeners is done? We just had BMO with us saying the next 3 weeks will define where the peak in rates is, and that comes down to Treasury funding and not the Fed.
I don't think that it's done. And I would even argue that this is not a 3-week event. This is going to be the end of this year into the first quarter. I think there's room for this to continue to move simply because markets are so attached to rate cuts in the coming year. And as long as the data stay as strong as they are, the Fed's going to have to push back against that very hard. We're going to get that on Wednesday.
Okay, let's bring Marcus into the conversation now. Marcus Ashworth is our Bloomberg columnist, and he has watched these markets alongside me for a long, long time. Right, here we go. Next battle on the line is the Fed versus the market. There's a cliche. That has never happened before. So how does the Fed push back at the rate cuts priced into the market next year? Do they need to? Good morning.
Hi. I don't think the Fed's actually that important anymore. I think they're out of the debate, and I think whatever Powell says is not having as much effect, and they ought to be a little bit worried about that. There is a dynamic here of supply very much, I think, driving yields higher. However, I think at the start of this week, we had a look over 5% in the 10-year, and we rejected it. So for now, I'm of the opinion we may have seen a turn in the markets, but maybe only a short to medium-term one. But I think the fact that stocks are down and bond yields are down is important. The only thing that I'm slightly worried about is the fact that the dollar keeps on strengthening. But you put those three together, I think we've seen, as we come into Friday, close of a difficult week, where the trends are. And I think that's important to note, is that I think there's been a trend turn, possibly in yields topping out, and more importantly, equities with the earnings season turning down as well. So that's going to be a different dynamic as we come probably into the fourth quarter, where we can start to see obviously a very strong third quarter GDP. Maybe that was again the peak, the last hurrah. At least we got through October without a crash. The seasonals are much better, has to be said, for equities coming up there end of the year. I'm not quite sort of talking Santa rally yet, but you know the dynamics are there for stocks. But for the moment, I think stocks are looking pretty weak.
Marcus, could there be another interpretation of the fact that Powell's comments recently have not elicited a big market reaction, and that's because he's sort of implicitly blessing this move higher in interest rates? I think if they wanted to really move the market and impact markets, they know how to do that. And the fact that he's choosing language that kind of keeps these trends in place, to me, implies that he may not be all that displeased with this tightening that's happening in the long term with the dollar and also with real interest rates.
I'm going to have to disagree with you there, I'm afraid. I think the fact what he said was so equivocal, to my mind, was the fact that he really was trying to rein in. If this bond yield move at the long end has probably been equivalent to certainly probably 3 quarter-point rate rises, that the market's doing the work for the Fed. He certainly didn't seem to want to push on that more. I got the impression he was like, enough already, without quite saying that. He can't say that yet, because he does want to get in these rate cut sort of arguments coming into next year, or certainly the back end of next year, he might be comfortable with, but not the forward part. And that, I think, is where the market is going to turn to next. I don't think he wants 10-year yields above 5. That was my impression, but, you know, I'm the born optimist.
Well, I think at the end of the day, you know, the data are going to continue to be a real focus. The really strong employment numbers that we got last month, if that pace of job growth continues, what do you think it would take to swing him back into a more hawkish position?
Well, I think I think that's probably, again, not to say the last hurrah, but we've had some very strong numbers in the back end of quarter 3 into the start of quarter 4. I don't think it's going to last. However, I don't think anyone knows what's going on, so let's not get sort of too clever with this. And I think Powell's almost admitting that. He doesn't really quite understand it either. Yellen certainly seems to give that impression as well. Look, it's confusing. The market's, you know, the economy is much stronger than the market had expected. I think a lot of people have thought the economy would turn down by now. You can see what's happening in the yield curve. It's all over the place. It's very confused markets. But yes, if we still get these big numbers on payrolls and clearly on retail spending and consumption and the rest of it, yeah, maybe he does have to go. I really don't think they want to. I think the Fed's done. I think the ECB's probably hiked too much. And I think the Bank of England definitely think that they're done as well. So I don't see any rate hikes coming unless, look, if the economy keeps on surprising the way it does, sure, all bets are off.
When you look at that data that we just got this morning, Marcus, core PCE jumps the most in 4 months. I'm surprised there's not a little bit more reaction in the bond market. Do bonds now, given the level of geopolitical angst, and I'm being generous with that word, we have a world at war, we have Ukraine, we have Russia-Ukraine war, we have Hamas-Israel war, we have concerns in the Taiwan Straits. I mean, multiple global threats. Do you think at some juncture bonds do what they were supposed to do and act as a haven, which they have, many say to me, not?
Yeah, I'm glad you mentioned that. The bonds aren't doing. Bonds should be 100 basis points lower in yields if there was any logic left in the world, but clearly there isn't because of the strength of the economy, and yet nasty inflation numbers don't help. Look, geopolitics doesn't matter until all of a sudden it does. So obviously we see anyone else stepping into this nasty situation clearly in Israel and Gaza, then I think the markets will react then. But for the moment, supply is dominating and too much of it, not enough buyers. China's been a big seller. So there are dynamics there, no real buyers, one big seller out there, and clearly the Fed itself isn't helping. The moment that's what the bond market is trying to contend with, and no one therefore is ready yet to step into that safe haven trade. Will it come? It could do, and if it does, it will be quite violently. I think a sharp drop down in yield. I think we've seen a bit of a turn in yields, but as I said, I'm probably clutching at some thin straws here.
No, it's fine. That's what living in the balmy British autumn weather will give you. I brought it with me here. It's rained every weekend since I arrived. Marcus Ashworth, I leave you to the British autumn. Bloomberg, a columnist. Lara, it's interesting. I mean, that's everything that this market should be doing, and it's just not.
Yeah.
It's just not. I mean, we try to philosophize about it, but I'm going to leave you with the closing thought. The one thing we haven't talked about is the Bank of Japan could pull off YCC, and that could just be the disruptor. Is that a risk that we should have at the tail?
I think this is the time in the cycle when those outlier risks really come in and amplify volatility. That emerging markets, I never discount something in currencies happening. This is the part of the business cycle where you start to get really nervous about, multiple sort of fat tail black swan events accumulating.
And the inflation story of 2024 is possibly going to be key as well. If this oil market really does take off, is that a tail risk for you, or is that migrating to the median, to the middle?
To me, inflation in 2024 is going to be one of the most defining trends. And I think that, again, could upset the apple cart of everybody sort of assuming that things are going to go back to normal. The genie's back in the bottle at 2%.
What's normal?
Right.
We're
going to have to figure that out again.
I think that's the whole issue. What is normalization of rates to 5-6%? Lara, thank you so much for being a sport. We got left on our own in the end, and we didn't break anything. Lara Rain of FS Investments, our guest this morning around the surveillance table. Don't worry, things will be back to normal on Monday. You will have Tom, you will have John, you will have Lisa, you will feel comfortable. Coming up on Bloomberg TV, 10:30 a.m., the Exxon chairman and CEO, Darren Woods, joins the team for a conversation on Bloomberg.
Earnings season is here.
Tons going on, lots of earnings. Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power. We're going to make more money. We're going to make more money. And we're going to make more money.
We're making bank. And I think that is what we could take away.
Bloomberg Television and Radio. Context changes everything.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
From New York City, for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. A bit of a reprieve after yesterday's sell-off that led to a correction in the NASDAQ. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, futures rebounding at the end of an ugly week for markets. Amazon providing a boost after big tech enters a correction. And another key piece of economic data comes in ahead of the Fed. We begin with the big issue, looking ahead to a critical week for markets.
We look ahead to next week.
Next week when the FOMC meets. What to expect from the Fed next week.
Next week's policy meeting.
We'll have a more hawkish hold from the Fed next week.
Beating that drum of higher for longer.
Maintain a very hawkish narrative.
They are also not talking about rate cuts, and we are not expecting rate cuts to come.
It's this give and take that the Fed has to manage.
The continued strength of the economy actually handcuffs the Fed.
The economy has much more resiliency.
The resilience of businesses, the resilience of the consumer.
The labor market that is just, very strong, a pretty strong labor market.
The Fed is looking at all of these data juxtaposed with inflation that's still too high.
The Fed is not looking to tip the market into a recession.
Everybody's wondering what these lagged effects of rate hikes are going to be.
Joining us now to discuss, Nuveen's Tony Rodriguez and Margie Patel of Allspring Global Investments. Tony, I want to start with you. How important is the Fed versus the Treasury refinancing agreement? In other words, is economic data in the driver's seat?
Well, good morning, Lisa. Good to be with you. Certainly for next week, I don't think the Fed is all that important. We know that they're not going to hike rates. I think it's pretty much consensus that they're going to have what you would call a hawkish hold. Right now, there's really no incentive for them to do anything but that. In terms of the refunding announcement, I think that also is news that the market is understands pretty well. Supply is higher. Funding needs are being pushed out into the long end of the market, and that's certainly pressuring the long end of the market. So ultimately, we do think it's the data that's going to be most important. What do we see? Today's data was important. What's happening with the employment report at the end of next week, I think, will also be very critical for prospects for growth as we move into 24 versus the rearview mirror look of GDP that we got this week.
Margie, your take? Margie, how much are you looking next week to what we hear out of the Federal Reserve versus the economic data?
I can't hear. I mean, I'm getting two sounds at once.
All right, well, we'll try to work that out. In the meantime, we'll stick with Tony, and we'll bring you back in when you have a better connection. Secretary Yellen, meanwhile, discussing the recent run-up in Treasury yields yesterday caused a lot of discussion. Take a listen.
We're seeing yields go up in most advanced countries. Part of the increase in yields, I think, is simply a reflection of the strength of the economy, the notion that interest rates will be higher for longer.
This arguably is somewhat political. Tony, your view, though, on how much angst about the deficit really has underpinned some of the fluctuations this week?
Sure, and I think obviously Secretary Yellen did need to basically say that most of the increase in yields was due to growth and not due to supply pressures. From our perspective, we'd say it's probably about half and half, maybe 50, 60% is the stronger growth that we've been seeing in the economy, but certainly close to half of it is from the increased supply and the fact that there's some uncertainty around demand for that increased supply. Certainly the Fed is no longer a buyer. In fact, in QT, when you look at some of the global players in the market, whether it's due to high hedging costs or economic pressures in their own countries, you're seeing lower demand as well. So we think that the demand will be replaced by buyers in the U.S., but in either case, there is a significant portion of this increase that has to do with supply pressures, with deficits that are much too high, and really no prospects when you look at what's happening in Congress for any kind of reduction over the next couple of quarters.
Tony, you said that economic data still matters quite a bit. I was surprised by the reaction yesterday to the strongest GDP growth that we've seen in more than 2 years, or almost 2 years, I should say. We saw incredibly strong, stronger than expected personal spending just moments ago. Are you surprised that Treasuries didn't sell off more in response to some of this?
You know, at the margin, we think that the 10-year around 5% is very attractive. Right now, it's a bit below that, of course. I would have expected to see a little more pressure upwards. But as I mentioned before, that data is more rear view mirror. A lot of the forecasts that you're seeing for fourth quarter GDP are down in the 1 to 1.5% neighborhood. So we do think this was a little bit of a, near term driven by inventory buildup, for example. So you're not going to see that repeated. So I think as you look forward, which is what the market is doing, we've already had a significant increase in rates to reflect stronger growth that we saw in 2023. And now I think the market begins to look forward to 24, which for us, and I think for much of the market, is a much weaker growth picture than the 5% that we just printed.
We get more key U.S. economic data out this morning. Bloomberg's Michael McKee joining us now. It's that sentiment survey that John always complains he doesn't get a call from and would love to. Mike, what are we expecting?
Well, I think people are reasonably happy, or at least they were during the month of September, because income and spending both came in fairly strong, not quite as strong as anticipated on the income side, up 0.3. The forecast was for 0.4. But you take a look at what we see there, and you see for another month that spending up 0.7 during the month outpaces incomes, which raises that question of how long can the consumer keep doing this. The savings rate continues to fall as well. But the question isn't really whether it's savings that's high or not. It's usually people spending what they make, and wages come in at a decent number, 0.5% up in August, 0.4 in September. People are still making money in their paychecks, and they still seem to be able to spend it. Disposable income unchanged on the month. So then the question becomes, what do people do going forward? Incomes and spending got to match up at some point, and as you can see there, the savings rate coming way down, and people spending more than they bring in. Lisa, looking this morning after these numbers at the WIRP function on the Bloomberg, it's a negative 0.5% chance the Fed does anything on Wednesday. Nobody thinks they're going to do anything on Wednesday, which is why that whole Janet Yellen thing is interesting, because a lot of people in the markets are saying that the refunding announcement is going to be more important than the Fed, since the Fed, everybody kind of has an idea what they're going to do.
Yeah, Ian Lingen earlier this morning making that point. Michael McKee, thank you so much. Still with us is Tony Rodriguez. And I am curious, Tony, how much are you seeing this idea of greater spending really bleeding through to a positive corporate picture at a time where everybody was so worried about borrowing costs, but they've been offset?
Yeah, you make a great point, Lisa. You know, the top line for corporations is quite strong. Consumer spending is the driver of the economy. It's why the economy has been much more resilient in 23 than most people, whether it was forecasters, the Fed, or ourselves, thought it would be. But again, we think that's really just pushed out the slowdown that we're expecting in the economy. Ultimately, the consumer is going to exhaust their excess savings. They've already gone through a little bit more than half of that from our projections. And when you think about what's happening with wages, a lot of the growth in wages is slowing down. We look at the Atlanta Fed wage tracker. That's come off. It's still too high to be at a comfortable level for the Fed, but it's moving in the right direction. You add in things like student loan payments coming back in, the bite from higher rates, certainly on durable goods, autos, home prices, et cetera. All of that, we think, will prove to slow consumer spending as we move into 2024. And that's what's going to relieve some of this upward pressure on longer term rates that's been so acute over the last 2-3 months.
So what do you prefer, corporate credit or full faith and credit U.S. Treasuries?
You know, that's a very good question. We do think that for conservative investors, when you see a 10-year north of 4.75%, that becomes an attractive level to begin to take on some duration risk, earn a high level of income. So we're very comfortable with kind of high quality, longer duration corporate credit. But we do like to dip down into below investment grade as long as you're only going down into the higher quality segment. So think double B credit, higher single B credit. There we think you're going to be able to earn a very high coupon and have a company that is going to be able to withstand the slowdown that we're expecting, because we're not expecting a hard landing. As you move into the lowest quality segments of below investment grade, those are the companies that I think are going to experience the most stress, and that's where you want to be a lot more careful in terms of your credit exposure.
Tony Rodriguez, stick with us. Thank you. Margie Patel, we are trying to reestablish her connection. Our apologies to her for the technical error. We want to get to some of the stocks moving ahead of the opening bell. Here's Abigail Doolittle. Abby.
Well, Lisa, we are, of course, looking at a bit of an updraft for futures overall, and a big piece of it, big tech. Amazon this morning is rallying in a very solid way. Investors encouraged by the robust e-commerce sales in the quarter that was, and the possibility of a stronger cloud business next year. So looking forward to the future. The stock up 6%. Operating margins beat by more than 200%. So the company did not sacrifice the bottom line for research. Instead, they put up a clean quarter. In addition, Lisa, this stock has been on sale, as you know, down about 12% over the last couple of weeks. So investors snapping up. Intel also sharply higher, up about 7%. They beat and boosted their outlook on a recovery in PC sales for the fourth quarter. They're now looking at a range for sales of $14.6 billion to $15.6 billion. The entire range over the estimate of $14.4 billion, plus they're looking at a profit of 44 cents versus 31 cents. Analysts very positive, saying that a turnaround is underway. And then ExxonMobil, not so much. The stock up a little bit, but they missed earnings and revenue, similar to Chevron. This has to do with weakness in both refining and chemicals. They boosted the dividend, and the cash flow beat estimates, so maybe that's holding the stock up right now. It's interesting right now, Lisa, because overall about 1% of companies are beating sales estimates, about 7% earnings, and yet stocks mixed. But this morning, we're having a positive reaction.
Abigail, thank you so much. Coming up, the U.S. imposing sanctions on Hamas.
The United States is announcing new sanctions targeted at Hamas's finances and meeting with our UK colleagues today to expand our efforts.
From Israel to China, geopolitics tensions simmering across the globe. Our team coverage coming up next in markets. A bit of a reprieve after a pretty difficult week.
The younger generations are are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
The United States is announcing new sanctions targeted at Hamas's finances and meeting with our UK colleagues today to expand our efforts. Today's actions go after targets and their additional assets in Hamas's investment portfolio and individuals who facilitate sanctions evasion. Today's designations also underscore the critical role Iran plays in providing financial, logistical, and operational support to Hamas and our commitment to curtailing these activities.
As you just heard there and reiterated by Janet Yellen yesterday, the U.S. is targeting Hamas with a second round of sanctions, the latest effort to restrain the terrorist group there nearly 3 weeks after its assault on Israel. But President Biden also has his eye on growing tensions in Asia. The South China Sea, now an area of concern as the Philippines, a U.S. ally, pushes back against recent Chinese incursions. Meanwhile, amid all of this, Chinese Foreign Minister Wang Yi, the top diplomat to Xi Jinping, is in D.C. and expected to visit the White House today to meet with National Security Advisor Jake Sullivan. Let's get to our team coverage when everyone is so focused on what's going on in D.C. Our ACE team, Bloomberg's Emery Horderin in New York, Keely Lyons in Washington, D.C. Emery, I want to start with you on this Hamas funding issues and how much these sanctions are viewed as actually helping to curtail that group that has been designated as a terrorist organization by the United States.
Well, for years, there's already been sanctions on Hamas, and they have not curtailed Hamas's actions or growth. And that was very evident on the October 7th massacre in Israel. But what you see now is OFAC and Treasury expanding that list. They are trying to make sure that any financing that goes to Hamas is cut off. So you have things like a CEO of a company in Sudan that allegedly is sending money to Hamas. He's going to be cut off. This is a financier. You have a Jordanian man living in Iran who many say is the representative for Hamas in Iran. He is going to be sanctioned. So the U.S. is trying to go after anyone that is left that has these links to financing and funding of what the U.S. calls a terrorist organization.
And we did just get this headline that U.S. is sanctioning individuals and entities for supporting Hamas. Kaylee, on the other side, we do have this top diplomat to Xi Jinping in Washington, D.C., has already met with others in the administration, now set to meet President Biden. How much does this represent an easing in tensions as we see what's percolating out in the South China Sea?
Well, Lisa, so often in the relationship between the U.S. and China, we see one step forward toward normalization and then sometimes step backward. Now, step forward is indeed what they're looking for here in D.C. as Wang Yi met with Secretary of State Antony Blinken yesterday. Wide-ranging discussion that will continue today alongside Jake Sullivan. And as you say, Lisa, there will be a meeting at the White House, according to Bloomberg's reporting, between Yi and President Biden. The question is whether anything can derail progress like what we're seeing in the South China Sea, because, of course, the U.S. is a close relationship with the Philippines. President Biden over the last week has reinforced that the U.S. will have an ironclad defense arrangement with the Philippines. And there has been a lot of tension between the Philippines and China in territorial waters in the South China Sea. Really, not without getting too wonky here, it's around a World War II era ship that has been grounded and that the Philippines uses to really reinforce its territorial claim over those waters. And there's been a lot of activity there and run-ins in recent weeks. So whether or not there's an escalation or if the U.S. were to step things up to support the Philippines. Could that be seen as some kind of provocation that risks derailing progress the U.S. and China is making? And of course, we are now just weeks away from a potential in-person meeting between President Biden and Xi Jinping that could happen in San Francisco at the APEC summit next month. President Biden has been hinting for a long time he would like to meet Xi this fall, but we haven't actually gotten confirmation from the Chinese that Xi will be making an appearance next month.
Kayleigh, Anne Marie, both of you, thank you so much as we parse through all of these events. Still with us, we are so pleased to say, is Tony Rodriguez and Margie Patel with the line reestablished. Our apologies once again. Margie, I want to go to you on the geopolitics of the moment. How much do you see this as weighing on equity valuations at a time where the top performers have been delivering in their earnings but still getting punished?
Well, I think it shows you that the trends are still in place, which is the economy is in good shape. The strong sectors continue to grow, such as technology, such as those part of industrials that are benefiting from the capital expenditure cycle. And I would say that there's only a limited connection between what the Fed is doing and the market. But I don't think the geopolitical is really weighing on the market. We've had a little lift in some of the defense names, but it hasn't really changed the fundamental positioning in the market.
Well, given that, Margie, some people are saying that there is looking for a reason to sell. We saw this yesterday from Julian Emanuel of Evercore ISA, because otherwise a lot of these earnings from the tech giants have been good. Do you view this as an opportunity to come in after the correction that we saw, or do you see this as too early? That frankly, there is something else weighing on things if it's not just the geopolitics at the moment?
Well, I think to have short rates at around 5.5% is definitely something that's drawing money away from the equity market. We haven't had those rates in well over a decade, and it looks like we should continue to have abnormally high Treasury rates compared to where you'd think historically, depending on the inflation rate, simply because there's so much supply of Treasuries. So I think that's going to put a little bit of a lid on how well fixed income securities can do. But in the equity market, I still think that looks pretty attractive because it's going to be more responsive to earnings growth. And as you saw by the numbers yesterday, the economy really is surprisingly strong, and people looking for a recession have still been disappointed.
Tony, how much are you seeing a new buyer base come into the bond space in terms of people who previously were equity buyers who are getting enticed by yields at these levels?
Sure, Lisa. So in terms of like the front end of the curve, the very short rates, 2-year to 5-year, a lot of individuals are investing in the Treasury market and fixed income markets and saying mid-single-digit returns. They look attractive to me given all the uncertainties out there. And when we go out to the longer end of the curve, you have a lot of total return-oriented buyers, endowments, foundations, pension plans, insurance companies, who again are also looking at returns in the 6 to 7% area for investment-grade credit and saying that meets my return target with much less volatility and risk than when we were at zero rates and I had to have a 90% equity portfolio to have any chance of achieving that return target. So those kinds of investors are looking at fixed income yields and saying we have pretty attractive return potential over the next 12 months.
Margie, how much do you see that as sort of the counterpoint to what you're saying, that people are going into equities because there's less of this sort of existential risk around refinancing, the Bank of Japan and all sorts of international buyers that might be stepping away, equities might be a haven from that, but on the flip side, the yields are delivering what you used to get in equities?
Well, yes, that's right. And I do think that the very short part, the Treasuries and money market type securities are drawing money away, but I'm not sure it's really drawing so much money away from equities or other long fixed income. I think it's really just taking away low rate deposit money flowing where the rates are higher, which is money market returns, and now CDs are starting to pick up. But I don't think we've seen really a fundamental shift in asset allocation. It's pretty hard to do if you've had disappointing equity performance, which many people did last year and even this year, to sell at big downdrafts and go into another sector that has only limited opportunity, which I would say Treasuries do. I think you have to be worried about this continuing supply of Treasuries, limiting the likelihood of getting lower Treasury rates in the next year or so.
Which raises a question, Tony, are people moving away from 60-40?
You know, there's definitely a lot of questions about 60-40. Our view has always been that if you think the 40 is the Bloomberg Average Index, which is really a highly concentrated Treasury mortgage portfolio, very high quality, that you should be diversifying away from that. There's so many more opportunities in the broader credit markets, moving into high yield, leveraged loans, preferred, CLOs, et cetera, that you do want to have a more diversified fixed income portfolio than what the traditional 60-40 looked like. But from the standpoint of I haven't, again, looking for an 8% return to meet my objectives. I think now fixed income, which was uncompetitive for over a decade in terms of that equation, now has a much stronger role to play in terms of a balanced portfolio. But you need to diversify beyond what the 40% traditionally offered you.
Margie, just a final word here. I know that you've traditionally been a bond investor who's gone much more into stocks because you see there's a better valuation opportunity there. Are you starting to shift back at all into bonds?
Well, I do think the top part of the high yield market, say companies rated BB, is really getting to be attractive. Those yields are between, say, 8 and 9.5%, which really is getting into the realm of competitive with equity. Also, many of those bonds are trading at discounts of 5 or 10% from their face values. So that gives you a little cushion. Also, I think the high yield market is much better than some of the other markets like loans. I think if we see defaults go up, it will be in the loan market, not in the high yield market, which is refinanced over the last decade and is better quality than we've ever seen.
Margie Patel, Tony Rodriguez, both of you, thank you so much. Have a wonderful weekend after this tumultuous week. Coming up, the morning calls, and later, Amazon topping earnings estimates after big tech enters a correction. That conversation still ahead with Loop Capital's Rob Sanderson and TPW's Jay Pulaski.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to suicide.
Bloomberg. Context changes everything.
Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Just quickly, we are seeing gains into the Open. Time now for our morning calls. We'll look at some of the analyst recommendations this morning. First up, J.P. Morgan downgrading Regions Financial to neutral, forecasting a challenging outlook after earnings provided limited catalysts. Next up, Cantor Fitzgerald upgrading Rivian to overweight, $29 price target, expecting solid demand to continue throughout 2024. And finally, HSBC upgrading Intel to hold after earnings, noting management's solid execution and improving PC demand. Coming up, TPW's Jay Pulaski joining us at the opening bell, plus Loop Capital's Rob Sanderson on Big Tech.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of trading, and you can see buy the dip is the theme of the day, up 0.8% for the NASDAQ. After entering correction yesterday, you could see S&P futures up a lot less, up 0.4%. Outside of stocks, you could see in the yield space, yields inflecting higher after that spending boost that we just saw. 10-year yields just marginally higher. It's pretty quiet today, 4.86% rounded up. A bit of euro strength now. It's been bouncing around all morning. And crude off some of the earlier highs, but still up solidly 1.3%, $84.25 in the NYMEX, as people get concerned about possible escalations in the Middle East. One stock to watch at the opening, it is Amazon. Shares jumping after delivering robust sales and profit growth. CEO Andy Jassy saying, quote, our cost serve and speed of delivery took another step forward as AWS growth continued stabilizing. Bloomberg's Ed Ludlow has more. Ed, what do you make of this? They actually did not beat, but they're still getting rewarded.
Yeah, that's a pretty good summary from Jassy of how investors have responded as well. Take a look at the shares. We're on track for our biggest jump since the first week of August, now up almost 6%. Cloud growth was around 12%, slightly below expectations for a dollar figure, but actually sequentially, this was the first time we'd had quarter-on-quarter growth in quite a long time. And the commentary from Andy Jassy did a lot of work as the catalyst to move shares in after hours. He did talk about the business stabilizing and said that they had added new customers in the early stages of the current period, in other words, the fiscal fourth quarter. Lisa, go back, compare and contrast what we talked about earlier in the week with Alphabet and Google Cloud. Because I asked Ruth Porat directly, did you add new customers in the quarter related to generative AI? And Ruth Porat didn't answer the question. Andy Jassy did. He said specifically, we have added new customers. And in the generative AI use case, it's going to be a platform for growth for a really long time in the AWS context. AWS accounts for the majority of operating income. That's been the case for quite some time. But on the bottom line, there was a lot of evidence that the work Andy Jassy's done to cut costs has worked. You look at some of the numbers in terms of the bottom line. Operating income, $6.98 billion. It's almost $1.5 billion more than analysts have been expecting. You're looking at record operating margins for that business going back many quarters. So that was good there. And then all the other things that we associate Amazon with, Amazon.com, advertising, also beat expectations. So we can get deeper into it later in the show, but across the board, good, with the exception that a technical miss on cloud was forgiven by investors because of the forward-looking commentary.
Thank you so much. Turning now to chips, Intel predicting a return to sales growth in the fourth quarter. The CEO saying, quote, while we're encouraged by our progress we know we still have plenty of work in front of us. The return of the personal computer. Bloomberg's Abigail Doolittle has more. Abby.
It does seem that there is a return of the personal computer. It was a very strong quarter, very clean quarter. They beat earnings by 91%. Sales, that was very impressive to analysts and investors, beating 4.6% in the quarter that was. But what's really jazzing traders is exactly what you're talking about, the guidance for the fourth quarter having to do with the sales range that they've offered of $14.6 billion to $15.6 billion, being above the estimate of $14.4 billion, and the profit for the upcoming quarter is also expected to be stronger, having everything to do with a demand for chips, because other areas of the business, there was a little bit of a slowdown, but some analysts are saying that they've really worked through an inventory here. And the big deal about the guide for the fourth quarter for both the top and the bottom line is it's that return to growth. They've been in an earning drought. I'm looking at the Bloomberg FA function here, Lisa, and quarter after quarter of negative sales growth. Well, for the upcoming quarter, it's expected to be 5.4%. For the first quarter of next year, 21%. So it's not just a limited event, potentially. It looks like it's going to be a trend. The stock on the year coming into today up more than 20%, jumping on the day. Its best day since November of last year. Investors are very encouraged by what they've seen out of Intel.
Abby, thank you so much. And tune in to our interview with the Intel CEO at noon Eastern today. Turning to autos, Ford falling short of Q3 estimates and withdrawing its forecast a day after negotiating a tentative contract with UAW. CEO Jim Farley saying, quote, "We were negatively impacted by the strike and our cost and quality remain a drag on our business." Isabel Lee has more. Isabel, this rhymes with what we heard from GM withdrawing guidance.
Hi, Lisa. So there are two stories here, really. Ford missing its third quarter earnings and Ford withdrawing its full year outlook for 2023. And it really comes down to the effects of the union worker strike, which lasted for around 6 weeks. It cost Ford around $100 million in the third quarter and a total of $1.3 billion so far. So let's tackle earnings first. Ford posted adjusted earnings EPS of 39 cents, at 9 cents higher than the previous year, but below the estimated 47 cents. Ford's revenue of $43 billion was better than expected, though, but its EV sales plunged 46%. The CEO noted that Tesla has set a good benchmark by trimming costs and really scaling its output. And when it comes to pulling guidance, there is a tentative labor agreement reached. Union leadership will vote on October 29. I won't go too much into detail, but the CEO said that this will add an additional $850 to $950 per vehicle. And Barclays is saying that this new contract could cost Ford around $2 billion annually. So if you ask Morgan Stanley, though, the pulling out of the guidance isn't really surprising because, for instance, its rival General Motors has also suspended its guidance. Lisa.
Isabel, thank you so much. And turning now to big energy, Exxon providing an unexpected dividend boost and posting a surprise cash flow increase. The CEO saying our disciplined operational and financial performance will position us to deliver profitable growth and attractive returns to many years to come. Joining us for more is Bloomberg's Simone Foxman. Simone.
Yeah, despite that dividend boost by Exxon, investors reacting to both their earnings as well as Chevron's with a bunch of disappointment. Both companies missing estimates per share pretty substantially. Chevron reporting adjusted EPS of $3.05 versus an estimate of $3.71. Exxon $2.27 versus an estimate of $2.36. And Exxon seeing particular weakness in its chemicals earnings, collapsing 70% from the second quarter and may get worse in the fourth quarter. It has the largest chemical footprint of any major, but it is a small part of its business. And that may be part of why we're seeing this divergence between Exxon and Chevron shares. This quarter, Exxon announcing that it had achieved its goal of reducing costs by $9 billion a year from 4 years ago. And CEO Darren Woods also talking about lithium in Arkansas for the very first time, calling those plans more and more promising. Meanwhile, Chevron, it had already had an announcement on dividends and buybacks growing earlier this week. And also there's a lot of focus on its acquisition of Hess, which may be a very expensive, at least more expensive than the Exxon's offer to buy Pioneer. But, you know, I think if we look at these shares, energy's been a bright spot lately in the market in the second half. You know, S&P Energy Index up 6.5%, but Exxon and Chevron have not really been driving that. And we're looking at these moves even on a day when WTI is up over 1%, Lisa.
Simone, thank you so much. And tune in to our interview with Exxon CEO Darren Woods at 10:30 a.m. Eastern. Meanwhile, stocks edging higher, but still on pace for a third consecutive week of declines. Our next guest recommending investors remain calm, writing, quote, "It sure feels like testing times." From UST volatility to poor stock market breath to the war in the Middle East, the good news is there's little to suggest we face another October 1987. The bad news is that the path through to the transition, the path to stability, and the $1 trillion reward remains a work in progress. I'm pleased to say Jay Pulaski of TPW joining us now with more. So translate that. Are you bullish or bearish? Are you basically one of the buyers who are buying this dip that we see this morning?
Yes, Lisa, good to be with you. And we remain constructive on risk assets. And look, it's been a situation where good economic news has been bad for stocks because of concerns about inflation and rate worries. We've been in a seasonal tough period. Our concern is that there has been some technical damage to stocks. Most sectors, most big indices, and many stocks are now below their 200-day moving average, which is a bit of a concern. But what keeps us constructive is that underneath the kind of poor headlines is pretty good data, and pretty good data across the board, whether you want to talk about manufacturing, whether you want to talk about growth, whether you want to talk about inflation, and most importantly, as you've touched on this morning, whether you want to talk about earnings. So that last bit in particular, earnings growth, is what's keeping us constructive on U.S. equity and equities globally as we look into Q4 and, more importantly, into 2024.
All right, let's dig into earnings. I've been struck this week that the forward guidance, that the prognostications of the CEOs and the CFOs have carried more weight in markets than the nuts and bolts of what the numbers show, which is not normally typical. The idea that Alphabet didn't get a boost from saying that they were going to go into AI, but Meta saw a big decline, at least in the initial throes of it, from suggesting that they don't know what's going to happen with advertising spending. Who does? And then Amazon coming out and allaying any concerns about losing cloud dominance by saying things are going to look really good and, hey, AI. Why do traders hook into some of this and not into others?
Yeah, no, that's a great question, and it's a great, weighing machine and leveling machine, which is the stock market, right? And so, as you know, we focus on ETFs in particular and more of a macro asset allocation perspective than individual stock picking. So for us at TPW Advisory, the focus is really on earnings growth overall for the broad market. And JP Morgan just came out this morning noting that with about 30% of the S&P reporting, earnings growth for the U.S. is up 12% year over year. The consensus going into the quarter, into quarterly earnings, was 1% plus or minus. And the guidance going forward has basically been muted, but we take that as a sign that the 12% earnings growth that is currently consensus for 2024 is intact. And if that's the case, then it's hard to see continued declines in stocks, but albeit that there has been technical damage and markets are unsure, and therefore you have kind of a trend of recent selling. The good news from our perspective is that we believe we're coming into a seasonal period which is very constructive, the best 3 months for stocks, November, December, and January. We have an environment where economic growth is fine, earnings growth is fine, and we think the surprise is going to be, Lisa, as we go into 2024, the surprise is going to be that inflation comes in better than expected. That caps the Fed, that caps rates, which already look like they're capped, and importantly, that suggests that the dollar is capped and starts to roll over, and those things are all constructive for risk assets as we look into next year.
The nirvana of a soft landing, how much does that get challenged by the idea that we got an upside surprise in spending, and that it seems like, I keep going back to this cliche, don't get between an American and a cash register. It has continued and persisted, at least what we saw this morning.
Yeah, we remember we've been focused on 4 guideposts, right, as we look to that unlock that stability reward you in our earlier ratings. One of those is disinflation. We just talked about that. We think the surprise is going to be lower than expected inflation. The second, manufacturing recovery. U.S. PMIs above 50, China above 50, Europe bottoming. The third is earnings we just talked about. Fourth is China where we look to see the data as better than expected fiscal stimulus. So we're constructive on growth continuing through next year. And we think the global economy, if we look at the three big regions, right, tripolar world, three regions, Europe is bottoming, Asia is picking up, both China and Japan, and the U.S. is in relatively good shape. We're not going to grow at 5% as we just did in the Q3, but we're not going to go into recession. When you look at the quarter-over-quarter growth in the U.S. going back the last 3 years since COVID, it's pretty hard to not see the first half of 2022 as the recession, 2 down quarters. We don't see any sign of recession in the U.S. in 2024. Consensus earnings growth is 12%. We're going into 2024 with a decent head of steam. And the good news is that inflation continues to decline. And if you look at the PMI data that just came out this week, it was very solid, suggesting that inflation is trending towards the 2% Fed target by mid next year. That's a full year ahead of where the Fed is expecting inflation to be. So if we get continued decent news on the disinflation side, rates don't go any higher, dollar rolls over, and that's, as we said, that's really the playbook as we see it, and we've become more comfortable with that over the last couple of weeks.
Jay Pulaski, we hope that that case comes to pass. Thank you for being with us. Coming up, Amazon boosting sentiment after a challenging week for tech results. That conversation coming up next with Loop Capital's Rob Sanderson.
When you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power. We're going to make more money. We're going to make more money. And we're going to make more money.
We're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
AWS, it's not a matter of if. We know public cloud is very early days. We know AI adoption and deployment is early days. So, when you have two really important divisions that are all, have much bigger growth tailwinds going forward, there's not a lot of companies that can say all of that. So I think Amazon has much more upside return than all the other Magnificent Seven names.
That was Eric Clark of AccuVest. Amazon signaling a boost for its cloud business as sales topped estimates. CEO Andy Jassy saying, quote, generative AI represents tens of billions in potential revenue for AWS over the next several years and growing very, very quickly. The market took this and ran with it. Ed Ludlow back with us from San Francisco. Ed.
Yeah, took it and ran with it. And even though it was a slight top-line miss for AWS, as we discussed earlier, the market kind of forgave them in part because the bottom line was so impressive in terms of outperformance, more than almost $1.5 billion of operating income, more than the street was expected. And it kind of sets up this really interesting earnings season, right? Earnings are important again, and that was a reference just then to the Magnificent Seven, but we've been thinking about the big five. Alphabet, Microsoft, and Amazon have all reported their earnings, and on a year-on-year basis, we got the massive adjusted EPS growth that we were expecting. Those big five, two to come at Apple and NVIDIA, and as a five, the expectation is that we see average EPS growth of 34% year on year. The S&P 500 overall is expected to have EPS growth that's flat, and if you took out those five big tech names, you would see EPS decline by about 5%. Apple's the exception to the rule, and I know that you're very excited about Apple, I am too, but its forecasts have top-line deceleration and modest EPS growth, so let's see what we get.
Ed, thank you so much. Rob Sanderson weighing in on Amazon's results, writing, quote, results should ease recent concern. We think commentary on AWS deal momentum and strong interest in Gen AI solutions will shift investor focus away from slowing growth. Rob maintaining a buy rating on the stock with a $200 price target, and he joins us now. Rob, why is it that the market took Amazon's word for it and didn't take Google's word for it when they talked about the promise of AI?
I think above just the Gen AI commentary, don't overlook the fact that they had incredible bookings momentum coming out of September, to the extent that the total deal volume in September was greater than all of Q3 combined. So, it's not only the Gen AI commentary, but this points to a meaningful reacceleration in AWS revenue growth, and that's quite different than what Google reported. They missed on cloud revenue by about 400 basis points, and said they're now stomaching some of the headwinds of cost optimization that Microsoft and Amazon have already sort of had a year's worth of headwind from that dynamic. So it's not only Gen AI that has, I think, people interested. It's the potential for reacceleration in cloud revenue growth, I think, is probably the larger factor here.
And right now what I'm seeing is that Google shares are lower on the day, even as all the others are continuing to see some buy the dip momentum. Rob, do you think that's the big takeaway from the earnings so far in the big tech space, that what you're seeing is a dominance of both Microsoft and Amazon at the behest of Google?
Yeah, that would be the takeaway from this quarter in isolation. I mean, that's the trends that the numbers were suggesting. And, Google had performed better in the trailing 4 quarters, and it's kind of catching up to them now. But they're a distant third in this race in just cloud services in general. Does AI get them in a better position over time? That's yet to remains to be seen. But yeah, that's the takeaway coming out of earnings from this single data point in this single period.
One thing that's gotten clear from the Magnificent Seven is just how different these stories are in terms of which specific economies they cater to, whether it's the spending of businesses or whether it's consumer spending. What have we learned in terms of what the trends are leading into Apple's earnings next week?
Yeah, consumers mixed. It's still pressured. Amazon results were solid on top line. Their guidance was a little bit light. There's a big margin recovery story that's happening beneath the surface on retail, and there's an awful lot of earnings power in the retail business. They doubled their plant capacity coming out of COVID, and the unit economics in their retail business are really upside down right now. I think that's being masked and the earnings power is yet to show through. They're losing quite a bit of money for every package delivered, and there's a long road ahead to restoring margins in the retail business. So in terms of consumer spending, it's still pretty squishy, and the Amazon results and outlook would sort of support a pretty tepid consumer.
How much is geopolitics going to really reign supreme in Apple's earnings calls, given what we've seen with China production and the potential competitive landscape?
Yeah, it's a risk. How much that shows up in over what time frame, I think, remains to be seen. But it's definitely something that investors have to take very seriously when they're evaluating what might happen next on the geopolitical front.
Rob Sanderson, thank you so much for being with us on a day where we do see a bit of a lift, a little bit of a buy the dip kind of moment following a correction that really entered that 10% territory yesterday after the earnings had already come out. A big question about why some companies are seeing a gain from some of the commentary and others not so much. Coming up, the market moving events that you need to be watching. That's next in our trading diary. Today, you can see that reprieve continue as the session grows older, about 23 minutes into the session, and still the NASDAQ leading in a bit of a rebound.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg's The Open. I'm Lisa Abramowitz in for Jonathan Farrell. Let's take a look at the markets. You can see it fading as the session grows older. The NASDAQ still, though, holding on to those gains up 0.9%. Outside of stocks, you can see in bonds, yields actually clawing back some of the gain that they had previously seen. Again, there's something going on in markets. Time now for the trading diary. You need to be watching next week. Tuesday, U.S. consumer confidence along with the BOJ rate decision. Wednesday, an FOMC rate decision followed by a Chair Powell news conference. We'll also get ISM manufacturing and job openings data, as well as a refinancing agreement from the Treasury Department. And Thursday, central bank decisions continue with the Bank of England, and then we round out the week with the October payrolls report on Friday. Today, it feels like a reset day after a tumultuous week. We've really tried to go up and down. The volatility is sort of benumbing traders to try to set and wait to understand the new paradigm. Maybe next week, when we get all of these central bank decisions, we'll get a better clue. This was Countdown to the Open. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Friday morning, we made it. Coming up, we're going to check in with Stuart Paul. He's a U.S. economist with Bloomberg Economics. He's going to join us to talk about some of the economic data we got today on the inflation front. Then we got to talk about the big energy companies, Chevron, ExxonMobil. They reported earnings today. We'll check in with Fernando Valle. He's a senior analyst at Bloomberg Intelligence. That's his bailiwick. Nadia Lavelle, senior U.S. equity strategist at UBS Wealth Management, to give us her market view. All that's coming up in the first hour. We got lots to do here today, and we're going to kick it all off with a Bloomberg Business Flash with Nathan Hager.
Right off with the latest consumer sentiment data from the University of Michigan, just crossing the Bloomberg terminal. The consumer sentiment for the month of October came in at 63.8. That was better than the estimate from economists surveyed by Bloomberg, but lower by about more than 4 points from the prior month. And 5-year expected inflation, 3%, a rise from 2.8. Watching stocks fade a little bit off the back of that latest economic data. We check the markets for you all day long here on Bloomberg. Right now, the S&P is little changed, up 2 points. 4137 is the S&P level. The Dow is down 0.3%, down 103 points, 32,679. The Nasdaq still holding on to a gain, up 0.2% or 85 points, trading at 12,681. It's been a mixed week for earnings from big tech. We had misses this morning from ExxonMobil and Chevron. Rebecca Patterson, former chief investment strategist at Bridgewater Associates, says after all these earnings, investors are looking forward.
They know that the strong revenues in the past were the result of a very strong consumer. We saw that in the GDP print Thursday from the U.S., 4.9%, led by the consumer. But that's all in the rearview mirror. People are looking forward. They're looking to the guidance they're getting. They're listening to CEO sentiment. and everyone's saying, okay, this is going to slow, and we need to be ready for that.
And looking at the Treasury market right now, the 10-year's down 1/32 for a yield of 4.85%. The 2-year is at 5.03%. NYMEX crude is down 0.1% at $83.14 per barrel. COMEX gold is down 0.3%, trading at $19.91.80 per ounce. The euro is at 1.0576 against the dollar. The yen is at 149.72. That's a Bloomberg Business Flash. Bloomberg Markets is on with Paul Sweeney and Matt Miller.
All right, Nathan Hager, thank you very much. I'm Matt Miller and Paul Sweeney live here in our Bloomberg Interactive Broker studio. The lights are on here in studio. That means we're streaming this stuff on YouTube. So head over to youtube.com and search Bloomberg Radio, and that's where you'll find it. Boy, we had the markets kind of all over the place here
University
today.
of Michigan, dude.
They have an awesome football team. This
all right,
might be the best
listen.
Michigan football team I've
Before
seen.
Do they cheat? Are they cheating?
That yet to be determined, but
Come on.
I haven't been following this.
Why do I never understood why the Patriots got away with that.
Yeah.
And
everybody does it.
And why is Harbaugh allowed to do this? I don't get it.
I don't know. We'll see what happens.
I mean,
I don't know why you don't change your hand signals.
Well, they got all the stupid
You
cards
got
and
4
posters
guys.
they're doing.
What are you talking about?
You can't figure that stuff
I
out.
mean, they got a lot of stuff to think about, Bailey. You know?
It's football, but they're smart because they go to the University of Michigan. So, but anyway, the UMich numbers came out today.
So very separate from the football team, I would say, because
the
the school is
people.
great, the economics department is fantastic, and we pay very close attention to these survey numbers. Sentiment coming out a little bit better than anticipated, 63.8. We were looking for 63 even. And we got most importantly, I think, the inflation outlook. Now, this is not great news for the Fed, because we were looking for 1 year out, the inflation expectations. We were looking for 3.8. The survey came back with 4.2%. And that is more than double what the Fed wants it to be. So you would think that they'd want to step on the brakes a little bit harder, but they seem content to just let this economy run for now.
Yeah, so we have kind of the markets all over the place, a little red, a little bit of green here. Bailey Lipschultz joins us. He covers the equity markets. He joins us here in our studio because he does not mail it in. What's that?
He's an orange man.
He's an orange man. Syracuse?
Yeah.
Syracuse.
There you go.
Terrible football program.
Terrible football.
Terrible.
But you got to start cheating. I guess that's the,
that's the moral of the story. What do you see out there in the marketplace, Bailey?
Well, S&P briefly in the red, but now bouncing now up about 10 points. It'll be key if we can see markets hold on to gains. NASDAQ still up 1%. That all on the back of strong earnings from Amazon and Intel. Amazon ticker AMZN right now up 7.6%. AWS unit showing stability, seeing a continued strength from the company. Just looking at some of the comments from management, really optimistic. And Intel, fueled by PC, ticker INTC, up 11% right now. PC market recovering, driving them to boost their forecast. Data centers a little less rosy, but you're looking at what we haven't been seeing the last few days, which is strong results being rewarded with investors going back into some of these big technology companies.
All right. I thought the Amazon numbers were good. And I don't even think the tech numbers in general. I know that people were saying Microsoft is really the only good one. Now we can say Amazon, but I don't know.
Of course, Amazon, their cloud business is gigantic.
Monster, yep.
When I think of businesses that maybe aren't doing as well against Microsoft, Amazon is not one of those businesses that I think of. I think of them as the leader, really, Amazon or Microsoft as a leader in cloud. By the way, Bailey, my takeaway from the Amazon story was, wow, Anthropic could be worth billions and billions of dollars. Did you see that? Amazon is investing $1.25 billion in Anthropic, which will use Amazon's technology to make its tools available to cloud customers, and as much as $4 billion. And Anthropic is one of these moonshot investments that SBF and FTX made before they went bust and lost everybody $8 billion.
Well, Anthropic's one of the handful of AI companies that we've seen draw a lot of interest that are still private. Them, OpenAI are the two that are top of mind when I talk to investors wanting to buy stocks that are still private. They're top of mind, top of the charts really in terms of institutional investors wanting to make bets on that space. AI really has been seen, AI and machine learning, as the sectors that are holding up better than everyone else in the private sphere. And when you look at optimism and doubling down from the likes of an Amazon, obviously Microsoft with its stake in OpenAI, that lends some credibility to it. But Matt, it is interesting that you bring up SBF, just given kind of what he's up to these days.
He's testifying, I guess. And apparently with a haircut that none of us has seen.
Oh. No. All right, here's the earnings story of the day for me. Chipotle. Stock is up 6%. Listen to this lead paragraph by Daniela Satori Cortina, which is just awesome. Chipotle Mexican Grill is anticipating that people using appetite-suppressing drugs for weight loss will go for its, quote, wholesome foods instead of indulging in fried alternatives, even if they're eating less. Stock up 5.6. I mean, imagine being the CEO of Chipotle coming out and actually saying that with a straight face.
Yeah, I mean,
I went there to Chipotle yesterday. They made my meal right in front of me, all fresh.
How expensive was it, though? I feel like it's like 18
20
bucks. 20
bucks. No. My 3 hard tacos and a small fountain soda is $15.30. But still, that's expensive. But still, I mean, I do it one day a week, but that's my...
On Ozempic, and you're at your doctor, and you said, like, what should I be eating? I don't think he would say, get a fried burrito at Chipotle,
I am not selling my McDonald's stock because of Ozempic. I'm just not doing that trade. I'm not buying it.
But I also learned, again, I'm younger. I learned on a call last week that Chipotle was a carve-out from McDonald's, which
I didn't know that.
Blew my mind.
Did not know that.
So...
Also, Paul is holding his McDonald's stock because he's from an age when McDonald's wasn't the most disgusting thing on the planet.
I love McDonald's.
Oh, of course.
So nasty. Would you ever eat it in your car? If you owned a car, would you eat McDonald's in that car?
The only thing I eat in cars in terms of fast food is In-N-Out. When I go home to California, I will eat In-N-Out anywhere, any time of day.
Yes, all right, In-N-Out. We'll do that. We'll go down that rabbit hole. I was out in California a few weeks ago, and In-N-Out, awesome. But I don't know. I don't know.
Did you order a generic burger? Because you have to have an order. Because my order is a double, whole grilled onions, mustard grilled, chopped chilies. Like, you have to know what you're going for.
Okay.
Otherwise, you're just getting kind of a
that's
cookie cutter burger.
I think I got the non-California, non-native.
No, dude, they knew you were a tourist.
Walking through the tour.
And they were like, this looks like a McDonald's customer.
Exactly.
Just give them the worst thing we have.
Exactly. Bailey Lipschultz, thank you so much for that burger review. Bailey Lipschultz, she covers the markets for Bloomberg News. Economists. I mean, I don't know. We're told we have to talk to them. So we bring this guy Stuart Paul in there. He's a new guy. I didn't hire him, but he's at Bloomberg Economics. He's an economist here, and we love talking to him.
He's not a new guy. He has a lot of experience on the street.
No, he's been around forever. Yeah,
he's a research fellow at the FDIC.
But who gets a PhD in economics? I mean, talk about it.
Work for Teal.
I know, that's pretty cool. Yeah. Hey, Stuart, you're in our studio, man. You get like a double star on a Friday in studio. That is
He's
solid
always in the
effort,
office.
man. You guys you and your team have a great story out or note out. Consumers lived beyond their means through third quarter. And then that's Matt Miller. I mean, as he's looking at his Dodge Challenger parked in a garage and coveting that. What are the numbers behind that? Have we exhausted all our savings and now we're just kind of borrowing, and that's how the big spending number comes out today?
Well, so the savings picture is a little bit complicated, but the headline numbers make it pretty clear that consumers were living beyond their means, and it was mostly due to discretionary services spending in the third quarter, and that continued through September. And so when we're looking really in real space, which is what matters most, we see real disposable income declining for 4 straight months, and gangbuster spending throughout the quarter, including on discretionary items. So the real question ends up being, what's the Fed going to do next? Fortunately, within the report, there's one little bit of a silver lining on the inflation side, and it's that there was actually deflation for some of the most important durable goods, some of the things that are going to be most front of mind for those of us who lived through June of 21, for example, and we're really focused on auto prices. Auto prices declining in the PCE report, furniture prices declining, the catch-all, other durables prices declining, and so we see monetary policy getting some traction, and they're just going to need to continue leaning against the consumers who have been spending down that savings pile.
Now, can they continue leaning against consumers? Can monetary policy get more aggressive even without them doing anything? That's kind of the narrative that the Fed has been giving us, right? This passive tightening thing that Bostic talks about.
Right. So the passive tightening would be that you see economic activity slowing in the background while nominal policy rates stay steady, all while the Fed is continuing to soak up liquidity by running down its balance sheet. That is possible.
I suppose it's not it's not doing nothing if they continue QT, essentially.
Yeah, I mean, they still call QT passive. It really depends how much there is in active sales to max out their caps of $95 billion a month. But they consider it to be one of the more passive elements of their monetary policy. And as they continue to soak up liquidity, as banks continue to see the effects of higher rates resulting in deposits leaving and the cost of credit becoming higher for consumers, it is the sort of thing that ends up resulting in slowing spending going forward.
Now, consumers living beyond their means, isn't that what Americans do in general?
Yes.
What's
exactly.
the
I mean, have we just gotten back to normal? Because when I put, you know, Torsten Slok's list of worries up to any of the bowls, and I say, you know, savings have been completely drawn down. Everything's going on a credit card these days. Delinquencies are picking up. The bulls always say, so what? That's how it was in 2019. This is how we do.
Well, so here's what's not the same as in 2019. Savings rates are extraordinarily low, and we've been...
Even with the higher interest rates?
Yeah.
Wow.
Yeah. So extraordinary 3.4% in September. 3.4% savings as a percentage of disposable personal
So proud
income.
of your daughter, Paul.
I am too, every time.
And that's while disposable personal income growth is negative, right? So think about what that means in savings space. I know that people like to, especially the bulls, like to look at this idea of cumulative excess savings as a source of additional spending power going forward, but that is not dry powder that's sitting in banks. That cumulative excess savings, as it's calculated, is really just foregone spending in previous months, and that money could have been put into Bitcoin or into whatever at $60,000, and it's gone, right? And we know that it's gone if we look at bank balances for the average person in the bottom 50% of the income distribution and adjusted for inflation. There is no excess cash balances for those folks.
I got to ask first about UMich. 1 year out, their survey just coming across the ticker. Participants expecting inflation of 4.2%. That's more than we thought they were going to say and more than double what the Fed wants it to be. Is that a concern?
So year-ahead inflation expectations don't matter as much as longer-term inflation expectations.
So we should be looking at the 5-year or what?
So we should be looking at the 5-year.
Why is that? It seems like I don't even know what I'm going to do tomorrow, much less a year, much less 5 years.
Yeah, because year ahead is so responsive to gasoline prices. That's really why. It's like a pretty simple correlation there.
That makes sense.
Yeah,
that tracks.
So we do want to look at the 5-year inflation.
5 to 10 year, we're looking at 3% on the survey that just crossed.
That's right. So that's for the median. The thing that most people are going to overlook that I don't want you guys to overlook is that the average inflation expectations 5-year out jumped pretty dramatically, up to 4.7%, from I think 3.2% the prior month. Right. So like that is something notable that the Fed is going to keep an eye on. We still think that the Fed is going to remain on pause through the October 31, November 1 meeting. There's still another opportunity to hike at the end of the year. But when you see durables prices coming off, as we did in the most recent report, we see consumer sentiment moderating a little bit month over month, and we see real disposable income declining for 4 straight months, and households clearly getting a little bit stretched, then the Fed can be a bit patient.
I just got one last question for an economist, which you are, and you have experience working with government economists as well. Economists are always on the one hand, on the other hand, right? And when you look at the surge in yields that we've seen in these markets, on the one hand, you could say, well, that's because of strong growth in the U.S. economy. On the other hand, you could say it's because of massive deficits that we have.
Right.
Janet Yellen yesterday said the surge in longer-term bond yields in recent months is a reflection of strong growth in the U.S. economy, not the jump in government borrowing driven by a widening fiscal deficit. Now, she would say that, right?
Talking her book.
I mean...
Is she just talking her book?
Totally.
Yeah.
Totally. Any economist would acknowledge it, because if we take it back to Econ 101, we're thinking about incentives and constraints, right? What's the Treasury Secretary's incentive here? It's to downplay the effect of running deficits that are pretty massive and being on an unsustainable fiscal trajectory for the next 30 years at least, right, over the entire forecast window. You look at what the Fed thinks, and it is going to be more so a matter of unsustainable fiscal policy.
That's what I thought.
This guy's good.
Yeah.
He's good. You can come back anytime, dude. Stuart Paul, he's U.S. economist for Bloomberg Economics, kind of breaking it down for us here. So that tracks right along with what you've been saying all along. I mean, we're just borrowing too much money, spending too much
Yes, and
money.
remember that I just parrot people that I hear on surveillance earlier in the morning, so it's not like I come up with this stuff myself.
Says the guy who just bought the Dodge Challenger with the Scat Pack.
Yeah, that's because I read Stewart's piece on Americans outspending their incomes, and I thought I should join. I should be a good American and do my duty.
Outspend your income, very good. S&P 500 up about 0.2%. The Dow down about 0.2%. We're seeing a little bit of action here, a little bit of direction on the NASDAQ. That's up 0.9% on the backs of some really strong numbers coming out of Amazon.com. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
While Intel is predicting a return to sales growth in the fourth quarter, Bloomberg Intelligence tech analyst Matthew Bloxham says it's a sign of growing momentum for its CEO.
Kind of suffer some really big revenue headwinds, so there's still a lot to do, but the momentum is improving, so recovery is there. And what we saw in the quarter just reported was a rebound in their PC business. So they've struggled with inventory at clients, and that inventory's been run down, so the clients are starting to rebuild their inventory again. That's fueling demand.
Intel shares right now up about 10%. And tune into Bloomberg today at noon when CEO Pat Gelsinger joins us live. A big day for Amazon after the company gave investors much of what they were looking for, robust sales and profit growth. Bloomberg's Ed Ludlow says its cloud division is regaining strength.
Cloud growth was around 12%, slightly below expectations for a dollar figure, but actually sequentially, this was the first time we'd had quarter-on-quarter growth in quite a long time. And the commentary from Andy Jassy did a lot of work as the catalyst to move shares in after hours. He did talk about the business stabilizing and said that they had added new customers in the early stages of the current period.
Amazon shares right now, they're up about 7.5%. But it looks like Microsoft is the one pulling ahead in the cloud recovery race. The company's Azure cloud business posted 29% sales growth in the September quarter. Meanwhile, Google parent Alphabet said cloud clients are still in cost-cutting mode. While Amazon's cloud revenue picture was mixed, as you heard Ed say, Microsoft also has a partnership with OpenAI. Microsoft shares are up about 1.5%. I'm Lisa Mateo. This is...
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's coming up to 10:22 on Wall Street. I'm Nathan Hager. Near-term inflation expectations measured by the University of Michigan are at a 5-month high, with consumers fearing higher prices at the gas pump. Investors seem to be taking it mostly in stride, though. We checked the markets all day long on Bloomberg. Right now, the S&P 500 is up 0.2%, up 8 points. The Dow is down 0.2%, down 64 points. The tech-heavy NASDAQ is higher by 1%, a gain of 121 points. Biggest mover on the Dow on the upside, Intel up 10.5%, on a positive outlook, while the biggest decliners, Chevron down 5.3% following disappointing earnings, and JP Morgan Chase down 2.7%, with CEO Jamie Dimon selling 1 million shares in the bank. It's the first time he's made that move since he took over almost 18 years ago. 10-year Treasury's little change, the yield 4.84%. The 2-year is at 5.03%. NYMEX crude is up 0.7% at $83.85 per barrel. COMEX gold is down 0.1% at $19.95.20 per ounce. The euro 1.0586 against the dollar. The yen 149.67. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Matt Miller.
Nathan Hager, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well. Coming up at the bottom of the hour, approximately, Alex Steele and Guy Johnson, Bloomberg. They're going to interview Exxon Mobil Chairman and CEO Darren Woods. So if you're concerned about the price of the pump, make sure you stick around for that. Exxon Mobil, Chevron, they reported numbers that were a little bit weaker than expected. How can you not make a ton of money with oil at like $80, $90 a barrel? I thought it only cost them $40 to take it out of the ground. So we'll have to figure out what's happening there. Fernando Valle, he knows that stuff. He is the senior analyst covering global energy for Bloomberg Intelligence. He joins us live here in the Bloomberg Interactive Broker studio, potentially the only one from BI in the office, and I note that includes management as well. Fernando, talk to us about what we saw from Chevron and Exxon here with their results.
Well, we saw Exxon really delivering on their promise to revamp their returns and actually covering their massive distributions from organic cash flow, while Chevron didn't quite manage to do so. And there are a couple reasons for that. The first one is the upstream side. Exxon's is really ramping up on their return on capital. And we talked about how their Qatar gas asset is world-class. And then Chevron's still a little struggling because of the higher inflation, higher interest costs.
All right, so we have a little bit of updated timing. We're going to hear from the chairman, CEO, Darren Woods of Exxon at 10:26.
Before we get to him, let me ask you about refining capacity, because we've had a little bit of, well, we don't really know what's going on. On the East Coast, apparently, refining capacity has been drastically reduced from not very much at all. How much is there down in Texas and Oklahoma?
Well, in total, we have around 18 million barrels a day of capacity. Not all of it is operable in the U.S. The majority is in the Gulf Coast.
I don't think it's capacity if it's not operable. That's, you know, we have 50 million barrels of refining capacity, but a lot of that hasn't actually been built yet, right? No. So what? We have only like 15 million barrels.
More like 17.
17. All right. Hey, you stick around, Fernando, because we're going to hear from the CEO of Exxon. We'll hear directly from him as we parse through some of these earnings from the big energy companies. Again, WTI crude oil today up 0.6%, $83.73 a barrel. The Brent crude, the stuff that's not coming out of West Texas, is about $88 a barrel. So we'll keep an eye on that. All right. Now we want to go to a discussion right now with Exxon CEO Darren Woods. He's speaking with Guy Johnson and Alex Steele, talking about the earnings that the company put out just last night. Want to get a sense of kind of where they're going in the upcoming months. Let's head over to that discussion right now.
Radio listeners, to take a look at ExxonMobil. The stock is down about 0.2% on earnings. Now, it missed earnings estimates in the third quarter. It did boost its dividend and a huge increase in cash flow. So we want to get more details here with Darren Woods, ExxonMobil chairman and CEO. Darren, we really appreciate you joining us on this very busy earnings day. I just want to start a little nerdy, and that's with the chemical side of the business. That's really what led to some of the weakness in earnings. Chemicals is a really wonderful indicator as to the global economy. What should be our takeaway from that weakness for you guys?
Well, I think there's two things to look at in our chemical business. One, obviously, is demand and the link to GDP, but the other is the supply. And we typically see that commodity cycles in chemical are driven by generally growing demand, but then peaks of supply coming on. And that's certainly been the case that post the pandemic, A lot of supply has come on. We haven't seen excessive growth in GDP, and so you're seeing that pressure manifest itself in very low margins. But that's a supply issue. Demand hasn't been as strong as in the past, but we're still continuing to see rising demand, just at a much slower rate than historical. My expectation is GDP begins to pick up and China continues to kind of come out of its post-lockdown issues, that we'll see growth in chemicals pick up, but we're still going to have to work through the supply overhang.
Okay, so that's more of a supply issue than a demand issue. That's good to know. To that point, if we just go to the broader oil story, because in some ways, let's get through earnings, but really the story for you guys is the Pioneer deal and the takeover there. And some of the numbers that you guys were tossing out here are huge, like increasing a provable reserve to 1 billion in the Permian. Some analysts are worried that you can't get that far. What are you guys going to do that gets you there?
Well, what we're going to do is what we're already demonstrated we're capable of doing. So if you go back in time, Alex, we set out a strategy to make sure that we were applying the full weight and force and capabilities of our company into the unconventional space. And that's been a concerted effort to develop technologies to improve recovery. We've been implementing that in the acreage that we've got today in both the Delaware and the Midland. We're seeing very good results. We've demonstrated the ability of those technologies, the techniques, and the development processes that we have in place. And what we're doing now is taking that proven capability and applying it to the best acreage in the Midland. And so Pioneer is basically in the fairway of acreage in the Midland. And so we've got this very good acreage that we're now going to apply the capabilities that we have in Exxon. So that's the combination. They are demonstrated capabilities that we have built into those synergy numbers. It doesn't comprehend the additional technology that we're working on today that's in the pipeline that, frankly, we think has promise. So our view is, while the numbers are big and it reflects the capabilities that we bring from ExxonMobil and marry up with the acreage and the capabilities that Pioneer has, we've got additional upside coming down the pipe.
Wow.
Darren, good morning. It's Guy. You are, to your point, and you're just talking about what is happening here, but I think it goes and speaks to beyond that and what else you're doing. You are proving to be very good at execution, project execution. You're demonstrating that. You've got a new refinery coming on. You are proving to be very good at that. Others in the energy space are not, particularly within the renewable space, where it is proving to be very difficult to execute well right now. Can you just talk to me about how big an advantage that execution story is and how you can leverage that to do more?
No, I think you've hit on a really important point, Guy, and you're absolutely right. It is critical, particularly in a capital-intensive industry like ours, to be very good at executing large, complicated projects. In 2019, we consolidated all of our resources on projects into one global organization. That organization has the sole focus of making sure that we are developing world-class, industry-leading projects and then executing them ahead of schedule and ahead of budget. And we're demonstrating that. That applies itself to our low-carbon solutions business today. And so if you look at the challenges of going from carbon capture or biofuels at scale or hydrogen at scale, marrying that with requirements of storing and sequestering CO2, we are in the sweet spot of pulling all those things together and doing it at scale, which is going to be required to address the challenges out there with respect to the size of the emissions that we have to reduce. There aren't any other players out there that have that same capability.
And that gives you a huge advantage. Now, you've just done the Pioneer deal. Alex was talking about that. Does that execution ability, though, now give you the opportunity to look at what's happening in the renewables space, where there is a tough time emerging, and start to cherry pick assets there as well and use your ability to execute to turn those assets around?
I would tell you, we're going to leverage not just our project capability, but our technology capability. And the way I've characterized it, we're a molecule company, not an electron company. And so we bring more value in the space required to manage and transform molecules, hydrogen and carbon molecules. That applies to CO2. And so what we're going to apply our capabilities to is the molecule side of the equation, which is carbon capture and storage, hydrogen, biofuels, capturing the emissions associated with existing hard to decarbonize industries that don't have any real practical alternatives, and applying that. So we see huge opportunities there. In fact, our low carbon solutions business is turning those opportunities into high return projects today.
Yeah. But I know that Dan Ammon has talked about the fact that he won't do it unless he gets those high returns for low carbon solutions. Darren, would that include buying a refiner, buying more refining assets. Like if you got to move the stuff, if you got to move the molecules and make different things out of it, you need different refining capacity.
So when we look at our refining circuit, we're looking for what I'd say is a diversified set of capabilities and advantages. So if you look at what we've been doing in refinery, we've been concentrating our refinery footprint and focusing on the strategic refineries that are producing high-value products in the lubricant space, the chemical space, the fuel space, the traditional fuel space, but also the opportunity to use our technology to then bring in biofuels and biofeeds to make lower emissions fuels. So we feel really good about the footprint we have today. You can't just go out and buy that from a refinery. It really comes from years of integrated approach to investing and making sure you've got a refinery that is producing a portfolio of products that meet society needs.
Darren, none of this happens in a vacuum. You must be watching very carefully what is happening in the Middle East. I assume you are. To what extent do you think there is the possibility of a repeat of the 1970s, another oil shock coming? Or do you think the supply base is now diversified enough to avoid that? And I'm also hearing conversations regarding the possibility of a super cycle re-emerging. Do you see any eventuality that could lead to that at this point? How would you address these two issues?
Well, I would start with the latter. And again, the industry is still recovering from the impact of the pandemic and the lower levels of capital that have been going in across the industry to offset the depletion that's been happening. And so supplies are fairly tight. So the big issue is, where is demand at? If you see real growth in demand, then that's going to challenge the supply base that we have, which will put more pressure on prices and margins. So I think it's really a function of where does the global economies go in the years ahead, because for the next couple of years, it's going to take time to get additional capacity coming on. With respect to the Middle East,
No, go ahead. Finish.
With respect to the Middle East, what I'd say, it is still an important region in the world. And while to date, the tragic events are not manifesting themselves in an impact, that's something we're keeping a very close eye on.
Darren, do you see the global economy entering a recession, soft landing? Do you see any of that on the horizon?
I think if you step back and look, the U.S. I think is in reasonably good shape. I think China continues a very slow emergence from some of the challenges it's had in the past. I think Europe is probably the most challenged region as I look around the world, and obviously they've been disadvantaged with the lack of energy security and some of the challenges they've had with the loss of affordable natural gas. And so I think that's going to continue to weigh on the European economies. And then I feel relatively comfortable with what we're seeing in the other parts of the world, and we'll see. We build the business to handle any economic situation. We certainly go through these cycles, and so we make sure that we're robust to the down cycle.
Darren, you kind of led me perfectly there, because I wanted to ask about LNG, in particular Guyana. You have a new partner there, and at Chevron, you guys are not unlike working with each other. You guys do this all the time. Have you talked to Mike recently? What kind of development can you guys come together and really drive technology to get more stuff out of the ground there?
Well, I think if you look at what we've been doing in Guyana, we've got a really good track record there. We're the operator there. We run the projects. We're developing those projects. We've demonstrated over the last several years the ability to bring in these large, complicated projects at world-class schedules, world-class costs. We're beating our budgets. We're beating our schedules. And then once we get them online, we're running them at levels higher than what the investment basis was. So a very successful development process. We've got 3 boats, the 3rd boat coming on here in November, and 3 more in the pipeline. So I think we've got a pretty good suite of technologies and capital projects that our organization is developing. We've worked with Hess in the past. Of course, we work with Chevron all around the world. I see them, their participation basically coming in and supporting the work that we've already demonstrated our ability to deliver on.
Darren, this is an industry that feels like it's back on the front foot, that you are optimistic, that you can see deals getting done. The industry is doing deals. We've seen 2 massive ones over the last few days, yours obviously included within that. A, do you think that's true? Which then takes me to a kind of bigger picture story. This industry has been pushed back hard over the last 10 years, let's call it, by the ESG movement. Do you think that ESG movement is now over?
I hope not. I don't think, ESG from our standpoint This is not an either-or proposition. This is an and equation where you've got to do both. You've got to develop the resources and the energy supplies that the world critically needs to support economic growth and support people's standards of living. And we've got to do things to reduce the emissions. We're working on both of those things. And so I don't see those competing against one another. In fact, to my point before, we're working on a set of solutions that are complementary and leverage the same skills and capacity. So we've always leaned into the need to produce low cost, low emissions energy sources and do that in our traditional businesses. We have continued to invest in that space, and we're continuing to work opportunities to grow value in that space. At the same time, we're leaning into the energy transition and using those capabilities to help not only reduce emissions in our own operations, but we're helping third parties, particularly hard to decarbonize industries, lower their emissions. We've got 3 large world-scale contracts with a fertilizer manufacturer, an industrial gas manufacturer, and a steel manufacturer to capture their emissions. Those 3 contracts in themselves is the equivalent of putting 2 million electric vehicles on the road. That's the number of electric vehicles that are currently on the road in the U.S. So think about that. 3 deals with carbon capture and storage equate to the same level of electric vehicles that are currently on the market.
Hey, Darren, we know you got to run. Thank you so much. We really appreciate you taking the time with us today. It was great to get through that. Next time, we're going to talk about 4-mile laterals and new technology. Darren Woods, ExxonMobil Chairman and CEO.
All right, that was Bloomberg's Alex Steele and Guy Johnson interviewing Exxon Chairman and CEO Darren Woods there. The company reported some numbers last night, as did Chevron. So we're hearing from some of the big energy companies. Still with us here in our Bloomberg Interactive Broker Studios, Fernando Valle. He covers all the energy space for Bloomberg Intelligence. So, Fernando, just stepping back, I was listening to what Mr. Woods was saying. What's kind of the investment call out in the street for Exxon today?
Well, I think there are 2 points. First, as Guy was trying to ask if they're ever going to do renewable power, they're not. I mean, I think that was pretty clear. He's going to continue investing in oil, and he sees an opportunity to seize market share from other players who have stepped back, namely the European players. And he's done that by buying probably the premier asset in the world in Pioneer and then going out and deploying some of his technologies. There's still some questions in my mind as to whether those technologies will actually have the impact he says, but there's no question that he bought the best asset available. I think as long as we believe that oil will have 20 to 30 years, he's done a tremendous job in retooling Exxon's portfolio. All of their main assets now have been acquired since he became CEO. And as he said, Guyana is the next best one, and it's a tremendous asset, as you saw with Chevron buying Hess, just to get into that.
So just a quick question on that. As long as we believe oil will have 20 or 30 years, are there people who think we won't use oil in 30 years or 50 years?
Well, I'm glad you asked. Not that we won't use it, but that will peak by 2030. The International Energy Agency just put out their oil outlook saying as much this week.
That will peak, that what, oil, the peak oil in terms of pulling it out of the ground will be 2030?
Demand
of
use will be 2030.
Does the industry believe that?
Well, certainly it doesn't seem like Darren or Mike Wirth from Chevron believe that. Otherwise, they wouldn't have bought 25-plus year assets on that.
Right. I think Fatih Birol tends to exaggerate in that direction, right? I mean, he also, well, whatever. We can move
But
on.
if we go talk to BP or Total or any of the European ones, we're going to get a different story than we heard from Chevron or Exxon.
Not so much from Total. Total, Patrick Pouyanné has been very open that he thinks, similar to what Darren Woods said, it's an all of the above. I think when you look at just energy demand and how much emerging markets still don't consume, it's the more energy you offer, the more you'll be consumed. So it's an all of the above, not just an if-and sort of solution.
Interesting.
I don't know. I think it's. We've heard peak oil so many times before.
Dude, I started hearing peak oil when I was a little kid, and I'm almost 50. But that's because I grew up with Charlie Maxwell. He was the first person to really call peak oil, and he was very wrong, you know, and certainly in terms of timing.
As long as Matt's driving, we won't hit peak
Yeah,
oil.
that's a great point there. Driving the Dodge Challenger Scat Pack, whatever that thing is, that burns fuel like you wouldn't believe, but it sounds good and it looks good. Fernando Valle, thanks so much for joining us. He's senior analyst covering the global energy space for Bloomberg Intelligence. Right now, let's get an update of what's going on in the world. Nathan Hager is going to join us.
Right to the numbers, Paul. We check the markets for you all day long here on Bloomberg. Checking ExxonMobil, it's down 1.8%. Chevron down 5.5%. The biggest laggard in the Dow Jones Industrial Average, which is down 0.4% or 139 points. Failing to offset the gain we're seeing from the biggest gainer on the Dow, that would be Intel, up 9.5%. Also, Amazon shares are higher by more than 7%. That's lifting the NASDAQ higher by 0.6% or 79 points. The broader S&P 500 is little change to the downside. 10-year Treasuries down 6/32, yield 4.86%. 2-year 5.04. NYMEX crude's up 0.4% at 83.61 a barrel. COMEX gold's down 0.25% at 1992.30 per ounce. The euro 1.0570 against the dollar. The yen is at 149.76. That's a Bloomberg Business Flash. Paul and Matt.
Nathan Hager, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker studio. We're streaming live as well on youtube.com. Looking at these markets, as Nathan was just reporting, kind of mixed out there. Lots of lots of economic data for the market to parse. Obviously, we are right smack in the middle of earnings, and we had some good numbers out of Amazon, offsetting some of the perhaps weaker than expected numbers we got from some of the other tech names earlier this week. So lots of crosswinds for this market to digest. That's why we check in with some pros who do this for a living. Nadia Lavelle joins us. She's a senior U.S. equity strategist within the global wealth management business at UBS. So Nadia, again, I was just kind of suggesting a lot of crosswinds. Seems like there always is for investors to kind of navigate here. You put it all together. You look at kind of what we're hearing from corporate America and their earnings, as well as the economic data, as well as the geopolitical data. What's kind of the message you're going out to for the UBS clients?
Our message is that we still remain constructive on the market. I mean, we had expected earnings to sort of be the stabilizer in the face of higher bond yields. And it's been a tough earnings season so far, not because companies are missing expectations. They're actually beating expectations, but the stock market response has been more muted and even negative. And those that have had weaker outlook on guidance have actually been punished in this market environment. And so what that is telling us is that the bar is high. And of course, those higher bond yields are also challenging the relative attractiveness of the equity market. But we do think that the market is hitting some key technical levels. You're now seeing the S&P 500 trade under that 200-day moving average and flirting with correction territory. So we think when we get into the back half of the earnings season, that hopefully that would act like a stabilizer and companies will continue to beat. We do think that the outlook for earnings has improved just given the strength of the economy. And so essentially we are buyers on this weakness.
Ah, nice. So, I mean, as we think about these markets here, I mean, I guess, are you at the point where you think we're at peak rates here and that the next move, whenever it does come, will be lower? Or you still have some Federal Reserve risk in your outlook?
Next week we'll see what the Fed messaging is. We do think that the Fed is done hiking. I mean, I think it's widely expected at this point that the Fed will remain on hold next week. We did hear some of that being echoed by several of the Fed speakers ahead of the blackout period. Some might say that November is a skip, but we think that the hiking cycle ended back in July. I mean, we all know that financial conditions have tightened quite a bit and the longer curve have moved up, and it's doing exactly what the Fed had hoped to do. So that transition mechanism of tighter monetary policy is happening. And as we heard Chairman Powell say last week, there could be even more in the pipeline, just given the fact that the Fed has raised interest rate so quickly over the last year. So we think that the hiking cycle is done. In terms of the outlook for sort of the 10-year Treasury note and the yield on that, reality is bond market volatility remains so high. And so it's difficult to know if we've seen a peak on the long end of the curve. We could see it test 5% again, but we do think that once the Fed is done hiking and that's clear and economic growth slows, we expect that the 10-year to come back towards 3.5% by the time we get to mid next year.
Wow. So you think, I guess investors, certainly domestic investors, are buying these bonds, but it doesn't look like there's any demand internationally, even at 5%. What pushes us back down? Do we get our deficits and debt under control as a country, or just the slowdown in the economy?
It's more the slowdown of the economy. We do know that there's a bit of a term premium that's being built in on the long end of the curve, just given the concerns around the deficit. So what we really think is going to drive bond yields lower is going to be a slower economy, inflation abated. I mean, you saw today in terms of PCE, yes, headline did surprise a little bit to the upside, but more importantly, core PCE continues to moderate. I mean, you have year-over-year core PCE at 3.7%. That's right in line with where the Fed had expected it to be at the end of the year. And so we're ahead of trend, and we think that that core PCE is going to come down even by another 25 basis points by the time we get to the end of the year. And so that's partly why we think the Fed is done hiking, and that should help to sort of stabilize bond yields and push them low. And we are looking for a period of sub-trend economic growth. We don't think that the momentum that we've seen in the third quarter is going to continue at the same pace. And so we think that GDP would come in under 2% by the time we get to the year end and into next year, and that's will help bring down bond yields.
Blue button. Thank you very much. Today's a big energy day for investors, Nadia. We had Chevron and ExxonMobil report their numbers. We here at Bloomberg Television, we just heard from the Exxon chairman and CEO, Darren Woods. What's your call at UBS for energy? Still some room to go there for energy investing?
We think so, and we do like it on this pullback, and it has a lot to do with our core view on the outlook for oil. I mean, we all know that global inventories continue to see drawdown, and they're at multi-year low, just given the continuous stance by OPEC plus the constrained supply. And we think that that's going to continue into next year, and demand remains quite robust. And then, of course, you know, we have the ongoing conflict and the war in the Middle East that could put some upward pressure to oil prices. And so we think that Brent oil is going to get back above 90 and probably hover around $95 into next year. And that should be supportive to the energy sector. You're seeing some weakness today, just given the earnings in terms of concerns around refining margins. And that's why we continue to prefer the E&Ps and some of the oil services companies within the sector.
If we get into a recession, which stocks take the biggest hit? Do you think, because last time we got worried about this market, it was interesting to see investors look to big growthy tech companies as almost safe havens.
You know, I think in terms of like traditionally what gets hits in a recessionary environment is the more cyclical areas of the market. You know, financials have been under a lot of pressure. The banks have provisioned for a recessionary environment, but you could see an additional letdown as there will be increased concerns around credit and defaults on credit and delinquency picking up. And so you probably see those areas, more cyclical areas of the market get hit. In terms of sort of the quality growth names, particularly in tech, remember these companies have very strong balance sheet. They're self-funded. And so we would expect them to be able to weather the storm a little bit better. There are parts of tech that are quite defensive, including software where recurring revenues are there, and also parts of tech like cybersecurity that we think are more defensive play than sort of the cyclical semiconductors of tech.
Hey, Nadia, thank you so much for joining us. Really appreciate getting some of your time. Nadia Lavelle, she is the Senior U.S. Equity Strategist for Global Wealth Management over there at UBS, where the Sweeney nest egg resides. So full disclosure there. Looking at these markets, all right, the S&P absolutely unched on the day. Nothing happened in there. Dow off about 0.4%. The NASDAQ up about 0.7%. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. Shares of Ford right now, they're lower, down right now about 8%, and this after the company withdrew its full-year outlook for 2023. Bloomberg's Isabel Lee says the carmaker also missed its third-quarter earnings.
Ford posted adjusted earnings EPS of 39 cents, at 9 cents higher than the previous year, but below the estimated 47 cents. Ford's revenue of $43 billion was better than expected, though, but its EV sales plunged 46%. The CEO noted that Tesla has set a good benchmark by trimming costs and really scaling its output. And when it comes to pulling guidance, there is a tentative labor agreement reached. Union leadership will vote on October 29.
Now, meanwhile, the United Auto Workers, that she was talking about, has offered a new contract proposal to General Motors that's similar to the tentative agreement that was signed with Ford. But that's not all GM is dealing with. Its robo-taxi unit has hit a speed bump. Bloomberg's Steve Potisk explains.
General Motors' driverless taxi unit Cruise has grounded its entire fleet just days after its license was suspended by California. It's a major setback for Cruise, which has been laying the groundwork to expand to multiple U.S. cities and Japan.
Now, Cruz says the most important thing is to rebuild public trust. GM shares right now, they're down about 2%. And there are signs of new car sales rebound despite higher interest rates. AutoNation, one of the biggest car dealership chains in the U.S., posted third quarter profit and revenue that beat expectations. Revenue from new car sales, well, that rose 11% to $3.2 billion, while used vehicle revenue dropped. The company said growth in its repair, financing, and insurance units also helped AutoNation right now up about 2.5%. I'm Lisa Mateo. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, red and green on the screen here on this Friday morning. The S&P up about 0.1%, the Dow off 0.3%, the Nasdaq up about 110 points. That's 0.9%, and on back of some of these tech numbers coming out, particularly Amazon. Yield space, the 10-year Treasury yield's just kind of steady here, 4.86%. You can still get 5% on your 2-year, but you can also get 5.02% on 30-year. So why take that reinvestment risk there? WTI 20. I know. WTI crude oil up 0.5%, $83.65. Let's head down to Washington, D.C. World and national news with Scott Carr.
Thanks, Paul and Matt. The U.S. is putting new sanctions on Hamas and Iran's Revolutionary Guard. The Treasury Department says in a statement today it's issuing a second round of sanctions, targeting assets in a Hamas investment portfolio and people who are helping the Palestinian militant group evade sanctions. There's a new push to reduce the record high numbers of empty offices around the entire country. Bloomberg's Amy Morris has more from Washington.
Under the Biden administration initiative, transportation money would be used to convert commercial buildings located near public transit into housing. Guidance from the Transportation Department will show states and developers how to use two federal programs for housing development near transportation. The programs have more than $35 billion available in lending capacity, and the department is ready to release guidance for transit agencies to repurpose their properties into affordable housing. In Washington, I'm Amy Morris, Bloomberg Radio.
A suspected mass shooter remains at large in Maine. Lewiston Police Chief David St. Pierre is asking the public this hour to remain patient as the investigation continues, noting there's several moving parts to it. 40-year-old Army reservist Robert Card suspected of killing 18 people and injuring 13 others after he opened fire inside a bowling alley and then at a bar. Almost 700 square miles of the state are under shelter-in-place orders, with officials saying Card should be considered armed and dangerous. Last night, law enforcement surrounded a home for over 2 hours before executing search warrants. And the World Series starts tonight in Arlington, Texas, between the Arizona Diamondbacks and Texas Rangers. Seats at the Rangers ballpark are not the only thing expensive. They're selling a $250 sandwich trio that starts with a 2-foot-long lobster roll topped with beef tenderloin. I guess they do things bigger in Texas. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Scott Carr, and this is Bloomberg. Matt Paul.
Scott Carr, thank you so much. We appreciate it. Matt, shares of Ford Motor Company are off like 9%. They had some weaker numbers, and they're pulling their profit forecast just like General Motors did here. So this strike thing, even though they've got, I guess, a tentative solution, this thing cost them some money.
Yeah,
the industry, they being the industry.
Absolutely. Well, and Ford specifically, right? They had forecast adjusted EBIT, which is earnings before interest and taxes, of $11 to $12 billion for the year. It had boosted that forecast in July, but they've just pulled this out. Now, GM and Stellantis still have to come up with a solution, agree with the UAW to end this strike. There's more pressure, I think, on those two because workers are going to go back to Ford plants in Kentucky, in Michigan. They're going to start making those Broncos again. They're going to start making those Super Duty trucks again. But you know, if you want a Jeep, or a Ram truck, a Silverado, an Escalade, a Yukon, a Tahoe, and remember, GM dominates that large SUV space.
Do they?
Think about the big 3-row SUVs, American, Land Cruisers. There's nobody else that does it like GM. They have the Tahoe, they have the Yukon, they have the Escalade. Now, I know Ford has the Expedition, but they don't have a big V8 in that.
No,
in that truck. No,
powering around with a V6.
Yeah,
Escalade?
they got the EcoBoost powering those. You may be able to get the 5-liter, but you can't get anything like the 6.2-liter V8, which is time tested.
Yeah, baby. The big numbers too on this strike. John Lawler, Ford's CFO, said the strike cost them a cumulative $1.3 billion so far. So that's big numbers there. So at least they got a tentative agreement. And as Matt was saying, man, the pressure's got to be on Stellantis and GM to come to a deal as well. We'll continue to follow that. This is Bloomberg. Good morning.
Happy Friday.
You betcha. What are you doing this weekend?
Nothing fun. Going out with a friend tonight.
Come down to the beach. It's going to be 80.
Nothing fun?
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Matt's favorite, Joe Misek. He covers all the municipal bond stuff here for Bloomberg News. There's always something fun to talk about with Joe Misek. Alex Chayleff, co-head of investment strategies at Bernstein Private Wealth Management. We're going to get his market call here. What does he think the Fed's going to do? What's he making of some of these earnings we've seen here? So we got a lot coming up here, and we'll break down all the news across the tape. And we're going to kick it off this hour. I don't know. Who we can kick it off with? No, we'll do it with Nathan Hager, despite it saying John Tucker here. Nathan Hager, go for it.
Sure. I'll stick around for another hour. Morning,
Nice.
Paul. Let's talk about tech stocks. That's really the standout right now with the NASDAQ up 0.9%. But it's been a really busy week when you think about the earnings, the economic data. The market seems to be looking past some of the latest economic figures, including near-term inflation expectations at a 5-month high and the Fed's preferred gauge of underlying inflation at a 4-month high. We did get strong results from Amazon and Intel as far as the earnings go, but weak numbers this morning from Chevron and ExxonMobil. Talked to UBS senior U.S. equity strategist Nadia Lovell, though. She says she is still constructive on this market. She joined us moments ago on Bloomberg Markets.
The market is hitting some key technical levels. You now see the S&P 500 trade under that 200-day moving average and flirting with correction territory. So we think when we get into the back half of the earnings season, and that hopefully that would act like a stabilizer and companies will continue to beat. We do think that the outlook for earnings has improved just given the strength of the economy. And so essentially we are buyers on this weakness.
As far as the S&P 500 goes right now, it's higher on the session, up 0.2% or 8 points at 4146 for the S&P level. Dow Jones Industrial Average is down 0.2% or 71 points, 32,713. Biggest laggard there, Chevron, down 5.5% following earnings weakness. But again, the NASDAQ leading the gains, up nearly 1% now, trading at 12,712. 10-year Treasury is down 230 seconds, yield 4.85%. The 2-year is at 5.03%. NYMEX crude is up 0.7% at $83.81 per barrel. COMEX gold is down about 0.2% at $19.93 even per ounce. Gold is flirting with a 2,000 handle. The euro is at 1.0580 against the dollar. The yen is at 149.56. Got a lump in my throat. Going to clear that now. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul and Matt.
I know. Nathan Hager, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. Streaming live on that internet thing, YouTube, the kids call it. Head over to youtube.com and search Bloomberg Radio, and that's where you'll find us. Lots of earnings out there today, lots of economic data out there today. Markets looking for a direction here, but let's break down what we're seeing in some of the numbers. We do that with Bloomberg's equities reporter, Alex Semenova. Alex, what do you got for us?
So let's start with Chipotle. Shares are actually
always
up
start there.
Nearly 8%. It's having a better day than some of the other stocks that we're looking at. That's after sales beat expectations, and the burrito chain forecast an acceleration in the fourth quarter, even as it raised prices. And we were recently talking about how Ozempic is the new AI. So we're seeing that in Chipotle too. Apparently their CFO was talking about weight loss drugs with a reporter here at Bloomberg. They said that they're anticipating that people using those drugs will go to Chipotle instead of some of the other fast food options.
We want to get your take on this, Alex.
We're calling this out as BS.
You're a healthy, fit person.
Fairly.
If you were really paying attention, if you wanted to eat the healthiest foods, if you wanted to make the best choices for your body, would you go to Chipotle?
I don't think that would be my first choice. I think I'd choose Chipotle over, say, McDonald's, but definitely not my first instinct to pick.
But I'd like that the company led with that. They're saying, well, we're going to take this, we're going to embrace this Ozempic thing, weight loss thing, head on, turn it the argument in our direction.
Exactly.
That was a nice strategy. I don't know if it works.
Everyone's mentioning it.
Yes, they are. It's
AI
a new
Junior.
It's
I think,
AI
for
Junior.
sure.
Very good. Very good. I went to Chipotle yesterday. Fantastic. What else we got?
Well, it's been a difficult week in the market, but I have a fun story for you guys. Bank of America has a new trade recommendation. They want to capitalize on what we're experiencing. So there's empirical evidence, obviously, that baby boomers are better off financially than millennials. They've locked in low mortgage rates. Their homes are appreciating. Millennials have a ton of debt, sky-high rents. So Bank of America says go long boomer stocks and short short millennial stocks for that reason. They're saying that this problem was made much worse by the Federal Reserve's interest rate hike, so they want to trade that disparity. They mentioned.
Can you give us some examples?
Yes, so on their boomer boom thesis, they recommend American Express. They say that American Express card holders are generally older, spend a lot more money, so money is going to be funneled into stocks like that. On the other side, they say that millennials, they're higher spenders on apparel retail, but because they have less money to spend, some of those names can suffer. They specifically mentioned Revolve, which is an online marketplace for clothing, and say that millennials will pull back on spending.
What is the place? Where do millennials go to buy clothes?
Are you a millennial?
I am a millennial.
And what's a millennial again?
So anyone who was born between 1980 and the late 1990s.
Okay.
That's the definition.
All right, that's not.
Is
our
there a
next guest.
place that was Urban Outfitters? Is that a millennials
It's
place?
making a comeback. I would say Zara probably. Revolve, as they mentioned, is a popular one.
What are you, Matt?
What you mean? I'm a Gen X.
You're Gen X?
It's really the most underrated generation.
Is it?
In Germany, they call us Generation Golf.
Why?
Because of the Volkswagen Golf. Because my generation, that was like, the ideal first car, right?
Okay. All right. I am a boomer.
You're barely a boomer.
By 3 weeks.
By 3 weeks.
3 weeks, I'm a boomer.
Yeah.
So I'm kind of a tweener.
But when I think of boomer stocks, I think of stuff that relates to Paul Sweeney.
Yes,
right?
exactly.
He still has the same Amex he got when he was probably just out of Lawrenceville. Exactly. The same green and white, like the classic Amex.
Yes, I am. Yes, I am. Anything else for us here?
Yeah, so also we're looking at Ford today. Shares were down more than 8% last time I took a look at my terminal. That's after they reported earnings per share for the third quarter that missed the average analyst estimate. The company also withdrew its guidance for the full year 2023 operating results, citing the effects of the UAW strike, saying that the future is a little bit unclear because of that strike.
Yeah, no kidding, man. That's a lot more expensive than I thought. I mean, $1.3 billion cumulatively so far for Ford, calling that out. That's big numbers. But they're still putting out like $11, $12, $13 billion of EBIT, right?
It is, and also, don't forget, these people want to under-promise and over-deliver. So
that's a strategy?
Yeah, I think that's a good strategy.
And didn't we give the auto industry a bunch of money during the...
Not Ford.
Not Ford.
Oh, you're talking about the pandemic. I thought you were talking about the bailout.
The bailout.
Yeah, the great financial crisis. Sure,
Yes.
Ford was the one that
did not
didn't take any. They were not on the government teat, so to speak.
Nice. Okay.
If I can say that. I don't know. I can say that, right?
Sure,
That's
we can.
It's a nature term.
We just said that. Yeah. Very good. All right, Alex Semenova, thanks so much for joining us. Always appreciate getting the update on these markets. It's Friday. It's around 11:10-ish. What does that mean?
Bam!
We talk municipal bonds, and we do that with Mr. Joe Mysak. Focus on Munis today is brought to you by Build America Mutual. Build America Mutual insures U.S. municipal bonds that finance essential American infrastructure and provides guaranteed income to improve any portfolio. Be part of Building America. Invest in BAM insured bonds. How about that? Joe Mysak joins us here in studio. He's the editor of Bloomberg Brief, focusing on the municipal market here. What are we doing here in the muni market?
It's crazy this week.
What's going on this week? Why is it crazy?
It's just crazy. There's so much. Even today, we have a couple of stories on the terminal out there about life in Texas. One about a $94 million football stadium, high school football stadium, that's on the ballot. In a school district, Prosper School District in Texas. And another story about their odd pair of laws they passed a couple of years back about discriminating against gun manufacturers and discriminating against fossil fuels. And basically, they're kicking out all the major Wall Street underwriters.
Well, this has been going on for a while, right?
Right, a couple of years. So, wow, these are two interesting stories, but especially this football stadium.
All right, so the football stadium store, it's a $94 million bond issue. Use of proceeds in part or in whole, I don't know what, is to build a high school football stadiom.
Yes.
This is Texas. Don't forget.
Texas,
it's the land of Friday Night Lights.
That's
right.
That's right. All right.
Yeah.
I think we have someone quoted there, like an ex-coach, who said that on any given Friday there's probably 50 places in Texas where there's high school football games being played out in front of crowds of 10,000.
Wow.
I had to say I grew up in the middle of Ohio, And we played high school football on Friday nights too. And it was a thing where in small towns, people went to the games even if they didn't have kids in the school. I mean, that was just a thing that you did on Friday nights. And when I moved, 30 years later to Westchester, it was really jarring to find that these pansy schools are playing football on Saturday morning. What is that?
Yes.
Gosh, okay.
I should not be allowed.
That's what we grew up with here. But you know what? I mean, you'll never see an NFL game on a Friday night, and you'll never see a major college game on a Friday night because it's just an unspoken rule within the game of football that you don't mess with high school football on Friday nights. You don't want to take any attention away from high school football. But man, Texas is huge. Florida, it's the whole Southeast. So let's go raise some public money for that and see what happens. All right. So youth park, but kind of a similar thing, a youth sports park in Arizona, that actually went bust, right? So we got some bondholders hanging on to some bad bonds here.
A good story by Martin Braun this week about this youth sports park in Arizona, and the bondholders are going to be almost wiped out.
Wow.
It's usually we have it's institutions who own these bonds primarily. We're not really talking about a retail item, but still, that sports park. We're going to have more stories about that as we go down the line. But it seems like it was just built too big. They were expecting $100 million in revenue, and I think they got like $25 million. So what does that tell you? A little too large.
Well, it's too hot in Arizona to go out and play and do stuff.
Imagine
for most of the year. It's crazy. All right, here's the one I like, because I am big on the convention business, because I know what a huge driver that is for a lot of cities. Most notably Vegas, my home away from home. You got to have the convention business because that drives everything else in town, restaurants, hotels, all that kind of stuff. They're doing some good business in Dallas, Texas, right?
Oh, man, Dallas. Dallas voters approved a plan last year, a master plan to rebuild, renovate, refurbish the K. Bailey Hutchison Convention Center, along with what they call an entertainment district next to it, which was going to be walkable entertainment for all the people who come to the convention. It is a $3 billion plan. They're selling $171 million in bonds next week to basically just get the engineering studies and architectural studies set up.
Well, my question would be, and I'll go look it up, who are the underwriters? Because I don't know who can underwrite bonds in Texas. If you support gun restrictions or any of that kind of stuff, they're kicking all these underwriters out. So do we know who's doing the deal?
As a matter of fact, that escapes me.
At a certain point, though, it's got to hurt your. If you limit the pool of banks that can bid on your bond business, you're not going to get the best bids.
It's a little bit of a throwback because what you're seeing is the return of the syndicate in Texas. And of course, you're going to, as you say, we're going to see bonds priced to sell.
Interesting. So
extra yield.
All right, I'm looking at the. There's so much great functionality on this thing. On the Bloomberg terminal, I'm just clicking through. Boom! I got to the prospectus. Boom, and it's got Ramirez and Company as the underwriter, but there's got to be a bunch of others. But anyway, but it takes you right to the prospectus. How cool is this Bloomberg terminal thing?
Oh yeah.
Joe, talk to us about Muniland as we've seen this huge rise in Treasury yields. How has it affected your world? Looking at 5% across the curve on Treasuries.
Okay, we are at on the 10-year, I think, a 363. But the surprising thing to me, the almost shocking thing to me, if you will, is that all during this year, volume, new issue sales have been off about 20%. 10%, 20%, double digits, well into the double digits, right? We are now, over the last few weeks, we're catching up. The issuers are catching up. We're down now around a little over 5%. So that's really surprising. Higher yields, the issuers don't care. We're going to sell bonds. We need to do it. I was looking at, you could find these whole laundry lists of things in municipal bond issues. Here's what we're paying for. We're paying for new sidewalks. We have to get a new library. We're getting a couple of police cars. We're getting, big 15, 20, items that, hey, it costs more to borrow now. Well, maybe a full point. Who cares?
Yeah, my town, Summit, New Jersey, we're building a new firehouse. I'm not sure why. I thought the existing firehouse was good.
Oh, yeah.
But what they're telling us is the new trucks that they have to have are even bigger.
Oh, okay.
So they can't fit in the existing firehouse.
That's
so we
so
have
funny.
So boom, there we go.
I wonder what they're going to do with the old. Do they knock down the old firehouse?
I have no idea.
I went to the Capitol Theater yesterday in Port Chester to watch the Blues Traveler play.
Really?
And
what you getting out about?
It was awesome. And
that's a throwback.
But as I was walking back to my car from the Capitol, which is what a great venue, you know, I walked by a firehouse. All the doors were open, so you could see the trucks. And then I noticed on the far end of the firehouse, they had a bar set up, and all the firemen were hanging out, like drinking. They had music playing. They were kind of partying. It's 11 p.m.
Yeah, why not?
So cool.
Yeah, the firefighters are the best. Hey, Joe, some community colleges in California are learning a hard lesson about free money. What happened?
Oh, man, what a story. This, we're working on this for a couple of weeks now. An investment firm has an idea for community colleges in California. Sell certificates of participation. Give us these certificates of participation, say an amount of $200 million. And we will give you money to pay the 3 or 4 years of debt service that you would pay. We're giving you that money. And at the end of the life of the loan, which in this case is 3 or 4 years, we'll forgive the principal.
Wow.
In other words, they're saying they can invest and leverage and do whatever they can based on this $200 million issue. They'll make enough where it doesn't cost you anything, and you're getting $200 million.
10
You're
seconds,
building
10
your
seconds.
new
What went
campus.
wrong? What went wrong?
We almost never see issues terminated.
All right.
So what happened? The school districts aren't talking, but
All right.
they said we did not get the money.
Didn't get the money. Joe Mysek covering
No,
all the
wait.
municipal bond stuff
No,
for us.
wait a
That's
minute.
it.
That's it.
That's it.
Oh.
Company news right now with Lisa Mateo.
All right, Joe. Good morning, everyone. We got a couple big misses from big oil on the earnings front. We have more from Bloomberg's Emily Grafeo.
Chevron and Exxon earnings both lower than expected, but if we take a look at Exxon right now, they did boost their dividend more than expected, and they posted a surprise cash flow increase. Whether or not that's going to assuage the investors, they lifted quarterly investor payouts to 95 cents a share, and that was a penny higher than the Bloomberg dividend forecast. And also look at third quarter free cash flow. That more than doubled from the prior period to $11.7 billion.
Chevron management now pointed to lower margins. Shares of Chevron right now, they're down about 5%. Now, meanwhile, analysts see weaker results in Exxon's downstream chemical business. Earlier this morning, ExxonMobil chairman and CEO Darren Woods talked with Bloomberg about that demand.
Demand hasn't been as strong as in the past, but we're still continuing to see rising demand, just at a much slower rate than historical. My expectation is GDP begins to pick up and China continues to kind of come out of its post-lockdown issues, that we'll see growth in chemicals pick up, but we're still going to have to work through the supply overhang.
Exxon shares down about 2%. And JP Morgan Chase CEO Jamie Dimon plans to sell about $141 million worth of company shares. Dimon says he and his family plan to unload 1 million shares next year for financial diversification and tax planning purposes. In a statement, JP Morgan says its chief still believes the company's prospects are strong and that his stake in the lender will continue to be significant. Shares right now down about 2.5%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Profits. Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's coming up to 11:22 on Wall Street. I'm Nathan Hager. We're watching stocks move mostly higher. Wall Street's taking the latest economic figures on near-term inflation expectations and the Fed's preferred gauge of underlying inflation, taking that mostly in stride. We're watching big tech trade near session highs. The NASDAQ is up 1.3% right now, up 170 points. The S&P's up 0.4% or 16 points higher. The Dow Jones Industrial Average is still a bit lower, down 0.2% or 71 points, dragged lower there by Chevron shares. They're down 5.3%. 10-year Treasury's down 3/32. The yield 4.86%. The 2-year is at 5.03%. NYMEX crude's catching a bit, up 1% or 84 cents at $84.06 per barrel. COMEX gold is down 0.4% at $19.90.10 per ounce. The euro 1.0592 against the dollar. The yen is at 149.62. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Matt Miller.
All righty, there we go. Nathan Hager, appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube. I don't know what to do with this market. No idea. Yields are higher. Can stocks work? Tom's in his triple leverage all cash fund. He's sleeping like a baby. But what do the rest of us do? Maybe our next guest can help us out here. Alex Chaloff, co-head of investment strategies at Bernstein Private Wealth Management. He's based in Los Angeles, where we got him live here in our Bloomberg Interactive Broker studio today. So that's good. Alex, what are you telling people if I come up to you at a cocktail party tonight and I say, what's your market call? What do you got for me?
T-bill and chill.
T-bill and chill. See, that's Matt Miller's been calling that.
Yeah, I like the ETF. How do you go about it?
Well, I think there's a number of different ways. I mean, anything on the short end is going to pay you. You're not taking any risk, and you have the flex to do something different. If we get some, I don't know if we will, but if we get some real dovish language from Chair Powell next week, then all of a sudden it's off to the races and it's go time. So I think you want to have liquidity. You want to have an ability to flex and do something. But I don't think it's binary. I don't think it's cash or something else. I think it's a mixture. And we're hopeful that Powell gives us a signal that it's okay to step a little bit out on the risk spectrum.
Does dovish language from Powell next week, does that just take the Fed out of the equation for the foreseeable future because they're not going to do anything on rates? They're still going to be doing QT, but they're not going to up it. Is that what you want?
Yeah, dovish language is like nirvana. He's not saying it, right? All we can hope for is we're thinking about. Yeah. So we're prepared for him to
thinking about cutting or thinking about being done?
Being done, yeah.
Okay,
our view is they're done.
Yeah.
Language is free, right? He can say whatever he wants in the presser, and that's what he's going to do. He's going to be just as hawkish as he's been and scare the heck out of everyone in the market, and that's just, we have to live with that. So our expectation is they're done, but they won't tell you they're done until well after the fact. And that's why we're talking to clients about T-bill and chill for now, but get ready to turn the dial. And there's not going to be a green light. He's never going to say, hey, everybody, we're done. He's going to hint and hint and hint, and you've got to read through the lines. But if you're a long-term investor, that's less important. It's more important to know that we're almost at the end. Whether we're right and he's done, or somebody else is right and they've got one more, we're really close to being done.
Yep, that's kind of the call here. The question is, how close? And so let's just focus on something a little bit more fundamental. We're smack in the middle of earnings season here. Any takeaways that you guys are focusing on here, or what are you looking for to hear from these management teams?
Yeah, it's still early. So our earnings scorecard isn't yet. I wish I was back here in a week, right? Because a busy week next week, not just the Fed meeting, but a number of really big names. I think the biggest learning that's emerged from the early part of the earnings season is how much companies who give poor guidance are getting beaten up. The guys that are delivering solid results, they're even getting the beats, and the majority are beats. The beats are ahead of what they've been over the last couple of quarters, so feel good about that. But boy, the misses are getting clobbered. And so the guidance, when the guidance is weak, either in printed or in the calls, look out, it's tough.
I get the same feeling. I get the feeling that if you meet or beat, you're okay. It's no big deal. But if you miss, they're going to take you to the woodhouse.
Yeah, it's always been that way. But I think right now, just in your opening comments, what do you do with this market? I think a poor guidance or someone coming out and just saying, look, I think next year is going to be tough, or even the first half of next year is going to be tough, you're right. You are getting taken out
We've
back.
seen some big beats. I mean, if I look at S&P Index EA Go on the terminal, 245 out of the 500 have reported on the S&P. Earnings surprise, 7.4%.
Yeah.
So big beats. And if I look down the list of who's done it, consumer discretionary is ripping. They're up 15% over expectations. And if you look at just growth over the same quarter last year, it's also huge. 5.8%, 5.9% in terms of earnings growth. And if you look at consumer discretionary, 54% in terms of earnings growth over the same quarter last year. If you look at communications, 35% over the same quarter last year. So they're doing well. Are we going to see these kind of earnings seasons continue into 2024? Are we going to see, 5, 6, 7% earnings growth?
Well, first I thought you were going to ask me, why isn't the market up on this incredible earnings season?
I know why the market's not up. You got yields that are off to the races, right?
Yep.
Offering, as you say, T-bill and chill.
Yep.
You got a lot of competition from yields. Plus you've got a rising dollar. Plus you've got rising oil costs. So,
yeah, no, it makes sense. It makes sense that we're bouncing around. And I think you also have this specter of a recession out there. So look, there's two things that are going on. One is the sell side is talking about earnings, and they really haven't budged their numbers much. We think that it's frankly the buy side firms that aren't publishing, that aren't telling you what they're doing with their numbers. They've taken them down. So we would expect to see some slowdown in earnings over the next couple of quarters. By the way, macro perspective, don't think we're going into recession, think we get through, but earnings will slow from here, whether that's this quarter or next quarter or Q2, we'll see. But it's definitely earnings slowdown from here.
By the way, is this normal being in, a red hot economy looking back, but everybody kind of biting their fingernails and worrying about a recession around the corner? Is that normal?
Yeah, there's so many people out there that don't even know what a 5% 10-year looks like, right? That people have said, oh, wait, can the 10-year really go? I mean, there's some people that think that's almost like an artificial ceiling. That's as high as it can go. Yes, this is normal. Even if you go back to the early 2000s when the economy was steaming, not knowing the GFC was right around the corner, but there was concern around, have we overcooked this thing?
I go on challengertalk.com. It's a forum for Dodge buyers.
Yeah,
and
I'm not on them.
And there'll be a headline, Challenger sales are down, and somebody will be like, yeah, because this economy's in the crapper, And I'm like, really?
Yeah.
5% GDP growth, 3.5% unemployment. This feels like a bad economy to you?
Right.
It does.
Yeah, and look at the participation rate is creeping up, and we're, like you said, wage growth has been consistent. Consumers are spending. I think what that comment is a reaction to is the savings rate coming down. So coming out of COVID, all that money pumped into the system, everyone had bloated balance sheets up and down the wealth spectrum. Now it's really the upper end of the wealth spectrum that has the dollars, and the lower end is spent through, and that's why you're starting to see credit card numbers pop up. So there really is a tale of two cities going on. At the upper end, everyone is comfortable T-bill and chill. At the lower end, we've seen a reduction in savings, and that's starting to, you can feel it.
When you guys do dip your toe back into the water, what are some of the sectors that you guys might be?
I think there's two ways to dip toe. One is into equities. The other, well, maybe there's three. Equities, fixed income. I think there you're going to be traditional. I think if we get a slowdown in earnings, if rates stay high, you want to be with quality, you want to be with good balance sheets, you want to be with reliable cash flow. But I also think there's an incredible opportunity that exists in the private markets. One, because public plans, big LPs are way over their skis with illiquidity and they're selling like crazy. And two, they've got no money to put into those markets for the next 2, maybe 3 years. And so the valuations are coming down there. And I think this is in primaries, it's in secondaries, it's in private equity, it's in venture capital, it's in real estate. It's everywhere in the private markets.
Because you used to be at Bernstein running the alternative asset strategies.
I was.
So talk to us, give us your 2 cents on private credit. Matt and I have just been fascinated over the
We're
last
about to quit.
Yeah, we're
here.
about to quit.
And we're going to go open up a private credit shop.
Yes. Private credit has been incredible over this cycle. People thought in COVID, oh no, this is the end, because a lot of the public BDCs were under pressure. But private credit lived through that, made money in that market, did very well in 21, made money last year in 22. And I've seen private credit numbers so far this year that have double digits on them on a year-to-date basis. So look, they've weathered the storm. It's all about underwriting. all about underwriting. If you're conservative, you're going to be fine. If you took crazy risk a couple of years ago because you needed to win that deal, you're going to be in trouble.
Yep.
Isn't there?
It's definitely a double-edged sword.
But nobody's watching these guys.
I wouldn't say nobody's watching those guys. I mean, we have a private credit business that we spend a lot of time really with our hands deep in it. I think others do as well. Yes, is the regulatory oversight different in the public markets? This is in private. That's a risk. That's definitely a risk. But if you're with somebody that's a track record of success in and out of tough markets, I'm going to say you're going to be fine.
Paul, what are you doing? Are you calling for regulation before we start our shop?
Before we start our shop. I'm just waiting for some big deal or a couple of deals to blow up, and then we're going to be like,
you want to write a letter to Elizabeth Warren? What are you doing here?
No, please don't. Yeah. You could have a couple of blow-ups, but that actually creates opportunity because there's so much money on the sidelines waiting to rescue that. That's the thing that I think people miss. If we have a blip in private credit, it's going to be like a 30-second blip because there's so much money waiting to just get in there and get after it.
All right, Alex, good job. I just promoted you during the course of this discussion from co-head of investment strategies to chief investment officer of Bernstein Private Wealth Management. So congratulations on that. We appreciate that. You're based in LA. Anytime you're in New York, you're welcome to come back in. Love hearing your market call here. Looking at this market here, S&P's up about 0.25%. The Dow's off 100 points. NASDAQ, a little bit of move there. We got the NASDAQ up 1.2%. Let's head down to Washington, D.C. right now. We'll get world and national news with Scott Carr.
Thank you, Paul. The House is back in session after an extended search for a new speaker, and lawmakers are already moving to censure and expel one another. Georgia Republican Marjorie Taylor Greene introduced a motion to force a vote on censuring Michigan Democrat Rashida Tlaib for her criticisms of Israel regarding its war with Hamas. Vermont Democrat Becca Balint retaliated by moving to censure Greene over her many controversial comments. Meanwhile, a group of freshman House Republicans from New York is trying to expel Congressman George Santos, who pled not guilty today to charges of wire fraud and ID theft. The House and Senate have grand plans for next week regarding government funding work, but they may face some logistical challenges, as Bloomberg's Amy Morris tells us.
Lawmakers have until November 17th to pass government funding legislation to avoid a shutdown, but some members are already talking about another stopgap measure. House Speaker Mike Johnson pitched an appropriations plan that included passage of energy and water spending this week and 3 more bills next week. But House members don't return to Washington until Wednesday. Senators, meanwhile, aim to pass their 3-bill appropriations minibus next week and will hold a hearing on a planned national security supplemental spending bill. In Washington, I'm Amy Morris, Bloomberg Radio.
A judge in New York has ordered Donald Trump's daughter, Ivanka Trump, to testify at the ongoing trial of the state's $250 million civil fraud lawsuit against the former president and his sprawling real estate company. Some say Sam Bankman-Fried is making a risky move as he takes the witness stand in his fraud trial this morning in a New York federal courtroom. The 31-year-old founder and former head of the cryptocurrency exchange FTX is accused of fraud. Witnesses have testified that Bankman-Fried directed a multi-billion-dollar fraud scheme. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Scott Carr, and this is Bloomberg.
Profits. Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. I'm Nathan Hager. We check the markets all day long here on Bloomberg. The Dow Jones Industrial Average is down 0.4% or 119 points, dragged lower by disappointing earnings from oil majors. ExxonMobil shares are down nearly 2%. Chevron is lower by more than 5.5%. JP Morgan Chase shares also helping to drag the Dow lower, down 2.3%, with CEO Jamie Dimon selling 1 million shares for tax and financial planning purposes. First move of that sort since he took the helm. But the NASDAQ is moving higher, up 1.2% or 150 points off the back of positive earnings from Amazon and Intel. Both those companies are up 8.5% right now. You put it all together, the S&P 500 is up 0.2%. But still, the sell-off in the S&P has it trading still near correction territory. Lisa Shallett, Chief Investment Officer at Morgan Stanley, takes an even broader view than the week.
Our perspective has been that we're going to continue to trade in this bear market range, which is where we've been for 2 years. I mean, people have to pull out their telescope and look at where we've been. You look at the S&P 500, we were here in the spring of 2021.
And here, right now, is 41.46 for the S&P 500 level. 10-year Treasuries down 2/32, yield 4.85%, the 2-year at 5.03. NYMEX crude's up 1% at 84.06 a barrel. COMEX gold down 0.3% at 1991.70 per ounce. The euro 1.0596 against the dollar. That's a Bloomberg Business Flash. Bloomberg Markets continues now with Paul Sweeney and Matt Miller.
All right, Nathan Hager, thank you so much. We appreciate that. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube, so check it out over there. Fixed income, 2022, the worst year ever for pretty much everybody in the market. Just brutal. Started off a little bit better this year in fixed income. But then, boy, the last 4, 5, 6 months have been really, really tough. And most of the, you look at the IN Go for the all the fixed income benchmarks, which Bloomberg owns, by the way, bought them from Lehman Brothers. They're all negative, with the exception of high yield. So again, a tough side here in the fixed income space. Let's talk to somebody who does this for real. Jason Greenblatt joins us. He's a senior portfolio manager at American Century Investments. Joins us live here in our Bloomberg Interactive Broker studio. So Jason, what are you telling your portfolio manager teams and all the analysts that are in American Century? How are you guys thinking about this fixed income market here? Because it's tough sledding out there.
Yeah, it certainly is tough, and I appreciate you both having me on, so thank you. What do we do here? So I think, one, you really need to do your homework, and the reason why I say that, and I know it's a cliche, is it's starting to become a credit pickers, or if you're in the stock pickers market, right? If you look at earnings over the past 1 to 2 weeks, the winners and losers are getting killed or really rewarded. Yep. The same's happening in the fixed income market, particularly in credit. If you look at leverage loans, it was an area of the market that we've been concerned about, yet it's one of the best performing parts of the fixed income market. And a lot of it is these companies, that borrow on a floating rate basis. Yes, they're getting resets in coupons quarterly, but I think that there's been differentiation between the winners and the losers, even within certain sectors and ratings categories.
Well, and you point out also, we were talking during the commercial break, you point out that the poor performance we've seen is more a result of rates than it is, specific corporate issues at these companies, right? Is that the next shoe to drop? Are you worried about the economy in 2024?
We are. And I think, we're positioned as such. Owning duration we like, right? Being long interest rates.
So owning duration means what for us equity people?
Yeah. Owning duration means when you're benchmark orientated, that you own more than the benchmark, right? Okay. So if you have a benchmark that's 6.5 years, you go out to 7 years, 7.5, because as the economy starts to cool off, rates could come down. Our view is it's not going to come down slowly. The market's starting to price in 25, 50 basis point cuts starting next summer. We think that it's going to be, when that happens, it's going to be harder, 100 basis point cuts, because something breaks. Now, if you look back in March, something did break, right? We had a few banks that went upside down, and what happened? The 2-year rallied over 100 basis points.
Well, and the Fed rushed to fix it quickly.
That's right.
Yeah.
That's right, and that's a sign. When the Fed comes in, that's your signal that at least temporarily there's a floor in place.
Yeah, that's a good point. What's the danger of going out duration? What's the danger of when the benchmark is 6.5 years, you go 7?
Yeah, it's inflation, right? And so that's the biggest concern that we've experienced is that inflation remains sticky. Is it going to settle in at 3 or 3.5%? Do we reaccelerate? We were talking before about autos. Some of the UAW strikes and increased costs. It's going to do one of two things. Either the OEMs are going to have pricing power or the margins are going to get squeezed. May not be a problem now, but as some of these cyclical businesses that have to deal with labor costs, something's got to give. It either comes onto us as consumers or the corporations are going to feel this margin pressure.
First of all, don't get me started on cars. So I think about your job, right? So you're taking a little bit of risk here, going a little bit out in duration. That means you're kept up at night thinking about inflation. You're watching every piece of data very carefully because you don't want to screw it up. So what's your call on inflation? What do you see happening?
Yeah, so I think, this last mile term that a lot of folks throw around, the last mile being the last 1 to 2
Right, we've come from 9 to 3.5, and now we just need to get down another 100 basis points, right? So
yeah, it's gonna be difficult from here. There are sticky parts of inflation that we're seeing, right? It was rent. However, there are signs that airplane tickets are becoming less expensive, right? There are signs that inflation is coming down. But yes, a reacceleration is our biggest fear. And I think, what do you do in this market? I think you stay close to home. You be very opportunistic. I don't think you need to really reach for triple C's here. So if we go back into corporate credit, I think having access to the market is critical here, right? And that's one of the biggest signs that we're looking for is the haves and have-nots. Some of the regional banks have issued this week with 7-handle coupons, single A rated. Okay, so you have an opportunity. You can own a 5-handle treasury, or you can own a 7-handle bank that has $400 billion in deposits. It's probably not going out of business. Buy that. It's a 5-year maturity. It's not going out of business. We don't have to reach deep into high yield to get really attractive alternatives to riskier assets, i.e. equities.
On that note, Jason, I have a listener writing in.
Okay.
With a question. Buying investment-grade financials versus non-financials is a consensus trade as financials are trading at decade-cheap levels. What's the risk here to that thesis?
Yeah, I have a feeling that may be someone I know, Ryan, who's asking that question. So a shout out to Ryan Aran there. What's the risk to that consensus view? Well, first of all, if it was consensus, wouldn't that spread collapse? That would be my pushback to the folks that we work with on the desk. Is there is a reason why there's a spread or a pickup in owning financials versus industrials. I think the other thing is that we've seen a lot of supply, right? 30+ billion of supply out of the banks, the GSIBs, the super regionals recently. That has certainly put pressure on spreads temporarily. Let's see what happens. Let's ask that question a week or two from now when the industrials come post earnings.
By the way, Ryan also asks, why does Penn State always let you down when it matters most?
Oh, man.
I watched Penn State play a football game last weekend.
Yes, you
against
did.
the Ohio State University.
Exactly.
So we have a team tomorrow that we're playing that I believe is 2-5. That at least we'll walk away tomorrow with a win. I'm not sure about Michigan, but we'll see what happens.
Well, Michigan comes to Penn State this year, which I believe, so that'll be a home game for Penn State.
Dude, Ryan went to ASU. I was looking at ASU the other day to see how they're doing, and it was like loss, 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 loss.
Fortunately, ASU has a great basketball coach, so it's all about the hoops.
I remember when they had a good football team.
Yeah.
Jake the Snake Plumber.
All right, Jason, thanks so much for joining us. Jason Greenblatt, he's a senior portfolio manager, American Centuries Investment, a proud graduate of Penn State University, Happy Valley there. So again, it's only one loss for Penn State against Matt's Ohio State University, but the season's still more games to go. S&P 500, we're pretty much unchanged on a day, up about 0.1 of 1%. The action's really in NASDAQ right here. The NASDAQ's up about 1% here. Yields, 10-year Treasury, 4.85%. You can still get 5% on a 2-year. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Apple is predicting a return to sales growth in the fourth quarter. Now, Bloomberg Intelligence tech analyst Matthew Bloxham says it's a sign of growing momentum for its CEO.
Kind of suffers some really big revenue headwinds, so there's still a lot to do, but the momentum is improving, so recovery's there. And what we saw in the quarter just reported was a rebound in their PC business. So they've struggled with inventory at clients, and that inventory's been run down, so the clients are starting to rebuild their inventory again. That's fueling demand.
Intel's shares up about 8.5%. And keep it right here on Bloomberg. CEO Pat Gelsinger joins us live at the top of the next hour. The social media platform, formerly known as Twitter, is eyeing some competition.
Executives at X said they see YouTube and LinkedIn as future competitors as X pursues new businesses in video and hiring. A source tells Bloomberg News that owner Elon Musk and CEO Linda Yaccarino called out those two sites during an all-company meeting to commemorate 1 year since Musk's takeover of the site, formerly known as Twitter.
And that was Bloomberg's Gina Cervetti reporting. Shares of Amazon are on the rise. Right now, they're up about 8%. And this after the company gave investors much of what they were looking for this earnings season: robust sales and profit growth, along with a hint that its cloud division is regaining momentum. Its cloud unit sales increased 12% to more than $23 billion. CEO Andy Jassy said the company signed several new deals with customers that took effect this month. Those are the company stories we're following this hour. We'll have more Bloomberg Markets in just a bit. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, looking at these markets here, got a little bit of red and green on the screen here, pretty much unchanged on the S&P. The Dow's off about 0.4%. Nasdaq's up 1% here. It's a pack of some good tech numbers. Yields, 10-year Treasury, 4.85%, pretty much unched on the day. Crude oil making a little bit of a pop here, up about 1%, $84 a barrel. And Bitcoin, after a lot of volatility over the last week, it is settling in here at about $34,000 per token on Bitcoin. DXY index is also off a little bit for your dollar. Right now, let's head down to Washington, D.C. Scott Carr's got world and national news for us.
Forces are saying they've conducted another raid in the Gaza Strip. This comes as their anticipated ground invasion into the Hamas-controlled territory could come at any time. According to the UN Agency for Palestinian Refugees, supplies of fuel, medicine, and food are running low in Gaza. Of course, the war between Israel and Hamas started after the militant group launched an attack earlier this month. Ivanka Trump is being ordered to testify in her father's ongoing civil fraud trial in New York. The judge in the case ruled Trump must take the stand after her legal team asked the court to throw out subpoenas for her testimony because she was dismissed as a defendant. The judge said Ivanka could not be called as a witness before November 1st. That gives her time to appeal the ruling. A suspected mass shooter remains at large in Maine. This morning, Lewiston Police Chief David St. Pierre asked the public to try and be patient.
I want to assure all that a tremendous amount of law enforcement manpower, time, and effort is being utilized around the clock, literally around the clock, in every effort to apprehend the suspect as well as to safeguard this community.
40-year-old Army reservist Robert Card is suspected of killing 18, injuring 13 others after he opened fire inside a bowling alley and then at a bar. Almost 700 square miles of the state are under shelter-in-place orders now, with officials saying Card should be considered armed and dangerous. And embattled New York Congressman George Santos has pleaded not guilty to the latest set of charges against him. The freshman Republican appeared in federal court on Long Island today to answer to 10 additional charges. They include making false statements to the Federal Election Commission and running up unauthorized expenses on his donors' credit cards. The judge set a September trial date. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Scott Carr, and this is Bloomberg.
All right, Scott Carr, thank you so much. We appreciate it. Jamie Dimon looking for a little liquidity, Matt. Selling some stock, I guess 1 million shares. So that thing trades like $140 a share. So that's a nice little windfall.
Dude, I think this is a great story on so many levels. First of all, I mean, he's the biggest name in terms of bank CEOs, if not in terms of all CEOs, right? He's been crushing it since the great financial crisis. I think he's the last remaining.
I think you're right. Yeah,
is he the last remaining?
Because Gorman now throwing in the towel.
So he's the last CEO, and that was
not
Mac.
throwing in the towel.
That was Johnny Mac, right? Before was Gorman? Gorman came in after the financial crisis, right?
Well, right, kind of like right there.
So anyway, it's Jamie Dimon. He's a big deal. This is the first time he's ever sold J.P. Morgan stock.
I can't believe that's amazing.
He's been there for 18 years, or at least he's been at the helm for 18 years. And the interesting thing is he must have been borrowing against his shares. Good point. Because, he's a super bazillionaire, and you've got to, get, yachts and big estates everywhere, probably in the south of France. He has some huge vineyard, whatever. You got to pay for that stuff. So he's been borrowing against his stock holdings, which for the last decade was no problemo at no rates, right? At 0 rates. But now rates are up, and even Jamie Dimon's like, I'd rather just sell some of my actual stock.
Right.
Plus, I think it's so cool. Mike Mayo points out this comes after he made some pretty negative statements. He was like, this is the most dangerous time in world history. Rates are going to 7%. The Fed's going to continue jacking them up. And banking is like a damned business.
Exactly.
So now